Street is even more bullish on Trump winning than the predictive markets are.
The most bullish for the dollar's a red wave.
Yields, I think, are moving higher based on the election.
To have a closely contested election would be very unsettling to the bond market.
I think inflation is due to notch higher, or at least stay stubbornly stuck where it is, no matter who wins.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Coming into Wednesday with tech earnings in focus, live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with equity futures up across the board. On the S&P right now up by 0.2%. On the Nasdaq 100 higher by a similar amount. Yesterday we had numbers from Alphabet, a blowout report from them. Today, Microsoft and Meta. Tomorrow, Lisa, Amazon and Apple.
Yeah, and what we're seeing is actually the fact of AI coming to the roost, coming to actually be profitable. And that's, to me, the big takeaway from the Google results. Essentially, AI was what helped them gain market share when it came to their cloud services against the likes of Microsoft and AWS.
And basically the fact that this cloud is doing so well, they're leaning into AI because of that, even though this competition they are facing on Google search, also advertising money really remaining resilient for this company.
That stock is up by something like 6% in the pre-market. Another name to watch this morning is Boeing. Boeing is higher by 0.4%. The union putting this out on the website. Just a couple of phrases for you. Productive face-to-face meeting addressing key bargaining issues. Are we getting closer?
Maybe. I mean, this is what we saw before. And essentially, this is them running out of cash, burning through some estimated $14 billion of cash. That's the estimate this year. This just needs to end to put a floor under some of the cash saves that they've seen. And then it begins some of the rebuild that they just raised money to do.
What number gets this done? They recently had a vote, and the raise was for 35%. And 64% of union members rejected that. Previously, the raise that Boeing came back to was 25%. And more than 90% of union workers rejected it. Are they going to go to the full 40% that those union workers are demanding?
33,000 of them. This is a key story for payrolls on Friday as well. The estimate in our survey is 110. In the last 24 hours, we've had some really mixed economic data comparing the JOLTS report for September to consumer confidence for October. Make sense of that, Bramo?
I can't. Basically, it's choose your own adventure. You can basically look into JOLTS and see something that's good. If you take a look at, for example, hiring coming up, you can see something bad. If you see firing also coming up and the fact that the quits rate went down. If you take a look at consumer confidence, a huge surge. So it raises this question, is this just a fickle indicator, or is this something telling us that the current conditions are moving quickly and moving upward in a positive direction?
Job openings the lowest since early 2021. Consumer confidence the highest since the start of the year, and the Federal Reserve's going to sit there a week tomorrow and try and make sense of all of this and decide whether or not to cut interest rates by 25 basis points. Equity futures right now on the S&P 500 positive by 0.2% in the bond market. Off the back of that data yesterday, yields declined. They do so again. We're down 3 or 4 basis points. The 10-year 421.62. Coming up this hour, we'll catch up with Katrina Dudley of Franklin Templeton following strong tech earnings. Terry Haines of Pangaea Policy with the Trump campaign in damage control mode. And Scott Devitt of Wedbush as Google's big AI bet pays off. We begin this hour with stocks inching higher after getting a boost from better than expected Google earnings. After the closing bell today, we'll hear from Meta and Microsoft. Katrina Dudley of Franklin Templeton writing, people are worried, cautious and generally bearish. We disagree. Tech company earnings continue to be strong. Katrina joins us now for more. Katrina, good morning.
Great, good morning.
Hard to be bearish with Alphabet numbers like the ones we saw after the closing bell. Are you looking for more of the same?
You know what? I actually wrote that statement before the Alphabet earnings came out. And I have a look. If you look at some of the earnings that are coming out of these technology stocks, it's really positive. And don't forget, it's positive surprises on top of earnings growth, which is very different versus like a positive surprise when you're expecting earnings to go down and they go down less. So I think it is actually very positive. But we are worried because everyone's bearish. The soft landing is kind of like, well, that's fine. And I think that we are just generally more optimistic.
Are you worried, or does it give you confidence that you're actually on the right track? If everybody is bearish, does that mean that actually there's more upside for you?
I think that there is a lot of upside in the market, and some of the indicators that we're looking at is look at the productivity data. The productivity number was 2.5%, and we haven't seen that type of growth for a long period of time in terms of positive productivity. The bearish people are pointing out to the fact that it's immigration. We're not counting the immigration numbers. We're not doing that correctly, and they're driving all of that productivity. We take a slightly different bent. them. We actually think this is one of the outcomes of some of the supply chain shortages and some of the reduction in the labor and tightness in that labor market. People are actually doing more with less, and that is productivity.
People. Is this the tech companies, or is this everyone? And I'm talking at a time when some of the earnings, particularly with auto manufacturers as well as certain consumer-facing companies, have been, not great. They're not the same kind of blowout results that we're seeing from the likes of Google.
And I don't like talking about this, but if you take a look at the low-end consumer, that is where you're seeing a lot of this weakness show up. So you look at the McDonald's numbers and you look, obviously we had the E. coli issue, but you combine that with the negative foot traffic. We are seeing the low-end consumer under some degree of stress. And I think what that's going to actually show up is potentially more in the election versus actually showing up in the stock market. Because even though there's a lot of people in the low-end consumer, it's not a big driver of spending. And so even though they are starting to see pressure, I'm not necessarily sure that they're actually going to derail the economy.
So this raises a question. If you do see this overarching momentum, and that could lead to higher yields, because essentially it could mean that a growth economy is really on the table for next year, at what point does that create some sort of downside to valuations for equities? Or do you just ignore it and say, stop being so bearish, bond market?
I think, first of all, we think in terms of valuation, the market's probably on a multiple basis is reasonably fairly valued. What people are getting wrong is the earnings growth number. And so the fact is that even if you just hold that multiple flat, if we continue to deliver better than expected earnings, the market can work because we'll still have that growth in actual underlying economy. So that's what we think the market is missing. They're so focused on the valuation level. We think that higher valuation is a reflection of some of the benefits of the network effect, which is driving some degree of concentration in the market, which is positive.
Is politics playing at all in your bullish view?
So let's go to politics. We're in the countdown, and I think it's an interesting thing. I think the non-consensus view is actually coming. If we look at some of the quant data that's coming out, there's approximately a 60% chance that we have one of these candidates with over 300 electoral votes, which would be a landslide victory. The problem is it's too close to call which of the candidates is going to be that way. I know you've seen some of the betting data, which is favorable to one candidate over the other. We're not necessarily trusting that data. I think, though, a landslide victory would be really good for the stock market and the economy, and therefore it actually, in terms of the November 7th Fed decision, I think that will also weigh in.
A landslide victory for who? A red sweep or a blue sweep?
That's the unknown. Unfortunately, I think that we will have a sweep. And I think that we'll have a fairly definitive outcome. Unfortunately, it could swing either way, which, however, I think you need to stand back and look at the fact we're going to this election with so much uncertainty that just having the fact that the entire country coalesced around one candidate will be very positive in terms of bringing the country back together.
And you think that'll be positive regardless for the stock markets, even though they have, in some regards, very different policies?
Yes. So what does that mean? If we have a Trump victory, obviously we need to start looking at the language that he's put out there regarding tariffs. The bearish expectation is you take him at his word. And that would be very negative in terms of, the tariff levels that he's talking, the 10% and then the higher levels of tariffs on China. I think he's a negotiator. So we're probably in the camp. I think it is also within consensus, the fact that he's actually just positioning and that he won't go that far in terms of what his language. So I think that in terms of outcome is going to be more positive. We don't see that negative downside scenario. Going to Kamala's policy, we go back, you want to start looking at some of those names which have been disproportionately and negatively impacted by exposure to the low-end consumer. You're looking at McDonald's. You may want to start looking at some of those regional gaming companies as well. So there's definitely some beneficiaries. I think you just need to look for those beneficiaries in some unusual places.
If we're talking about a sweep, though, we're talking about the difference between a 15% conditional corporate tax rate or one going up to 28%, aren't we?
I don't necessarily think 50. He likes round numbers. Okay, so we're at 21%. But when he first talked about it, we were at 35. So the difference of going to 35 to 21 is significant. I think if he goes anywhere, it's 20 to 21 down to 20. As I said, he's a round numbers person.
What about 21 to 28 on the Harris side blue sweep scenario?
It will be a headwind to corporate earnings. I think that you cannot underestimate that, but offsetting that is her position on tariffs isn't quite as extreme. And then you have some of this support for the low-end consumer. She's talking in terms of some of the transfer payment metrics. The concern that we have, does the corporate tax rate increase come in fast enough to offset any of the increase in the fiscal deficit driven by her
You're looking forward to seeing the back of all of this next week?
I'm actually enjoying it. I think it's interesting because this is what drives markets, and this is what makes our job so interesting. But you're right. If I come back, in a week's time, we're going to be talking about something else. We will be talking about 2025, actually.
I hope we are. I really do, and I hope we're still not sitting here trying to figure out who actually won the election. Equity futures on the S&P up by 0.1%. Katrina, it's good to see you. Thank you.
Great.
As always, Katrina Dudley there of Franklin Templeton with an update on stories elsewhere. With your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. UBS posting a profit of $1.4 billion in the third quarter. That's nearly double what analysts had predicted. In an interview with Bloomberg, CEO Sergio Amati warned of risks from the U.S. presidential election.
The markets are pricing rather a Trump victory, and think that if this is confirmed, it remains to be seen is a classical sell-on news event, or how he wins will be also determining, is he in control of the Congress? If Kamala Harris wins, of course, some of the trades that are ongoing for Trump will probably have to be reconsidered, and therefore they're going to create rotations in the market.
Amati going on also to tell us that consolidation in European banking is necessary. AMD shares, those are falling in the pre-market trade, down more than 8.5%. The chipmaker's fourth quarter revenue forecast missed estimates. Its AI sales are going more slowly than some had anticipated. The company expects to get more than $5 billion in sales from AI accelerators this year. But some on Wall Street were looking for an even bigger bump. The Yankees are still alive after beating the Dodgers in Game 4 of the World Series. New York was facing elimination after falling behind 3-0 in the series, but managed to rally behind hometown hero Anthony Volpe. The win keeps the Yankees from becoming the first World Series team to get swept since 2012. They now need to win the next 3 games to win the series. And that's your brief. John.
Danny, thank you. The one thing more volatile than the bond market, the price of Yankees tickets. Are they back up this morning?
I think so. I haven't
probably.
checked yet.
You got a victory lap for us?
I'm scared to check because I really would love to go tonight. Oh, it was just an incredible game. But the most incredible moment is actually really bad for Yankee fans. Did you see this?
Taking the ball out of Mookie Betts' glove?
Yeah, and bad sportsmanship.
Well, hold on a second. You can say it as maybe bad sportsmanship, or just they were so excited at this moment
come on.
that they were potentially going to catch this ball. And you know what? They had more fight in them, I think, than we've seen from these Yankees the past few nights. But obviously, very dangerous, and you should never do that.
Nice save, Anne-Marie. Nice save. Up next on the program, damage control.
I have no idea who he is. Somebody said there was a comedian that joked about Puerto Rico or something, and I have no idea who it is.
Damage control on both sides. That conversation just around the corner from New York. Good morning. Live from New York City, welcome to the program. Equity futures right now up by 0.2% on the S&P 500. In the bond market, the rally continues for a second day. Yields are lower by 3 or 4 basis points. The 10-year, 4.2162. Under surveillance this morning, damage control.
I have no idea who he is. Somebody said there was a comedian that joked about Puerto Rico or something, and I have no idea who he is. Never saw him, never heard of him, and don't want to hear of him, but I have no idea.
So here's the latest. Donald Trump distancing himself from remarks about Puerto Rico made by a comedian at his MSG rally. Meanwhile, President Joe Biden lashing out at Trump supporters.
And just the other day, a speaker at his rally called Puerto Rico a floating island of garbage. The only garbage I see floating out there is his supporters.
Quick to fix his gaffe, the president turning to X, posting, I referred to the hateful rhetoric about Puerto Rico spewed by Trump supporter at his Madison Square Garden rally as garbage. Bloomberg's Katie Lyons joins us now for more. Kaylee, is anyone buying that?
Well, it's definitely not actually being sold well to Trump supporters. They are saying that this is like in 2016 when Hillary Clinton called them deplorables, a similar thing here that President Biden is saying. Now, the White House is saying if you look at the transcript, it actually says supporter apostrophe S in reference to this specific comedian. And when you look fully, he does then go on to say his actions are deplorable. So it does seem like he was referring to one specific individual. But still, this is not the kind of gaffe you need in the 11th hour with less than a week to go until the election. This, of course, follows last week, President Biden at one point saying Donald Trump needs to be locked up, then quickly correcting himself to say locked out, politically lock him out. And so this may be one of the reasons why we are seeing the Harris campaign distancing Joe Biden from the campaign trail. He is not joining her in this final week in the same way we may have seen historically, as they not only try to create some separation potentially from the political liability of gaffes like this, but also some separation from the unpopular policies of this administration as they try to make Kamala Harris a change candidate and make this election a referendum not on Joe Biden, but on Donald Trump.
Someone in the Harris camp actually wanted to point out to me that apostrophe last night, Kaylee. That apostrophe seems to be doing a lot of work. The bigger question is, why was Joe Biden doing anything last night when it was supposed to be Kamala Harris's moment to stick the landing?
Well, it's an excellent point, Anne-Marie. What he was doing was a virtual call with Voto Latino, of course, a group focused on getting Latino voters out into the polls. He was not at the Ellipse last night, even though Kamala Harris was just, 500 yards from the Oval Office, standing in front of the White House, lit up at night. Joe Biden was not there. While they were trying to make her look presidential, sources with the campaign have said that last night wasn't just about hearkening back to January 6th, given Donald Trump spoke at that same spot in January 2021 before his supporters stormed the Capitol. It was also about making her look presidential, like someone the American people could see serving in that role. Noteworthy, though, that the current president who is serving that role was not there alongside her. And it'll be interesting to see if there's a communication with the campaign in the White House to have Biden pull back on his activity in these final 6 days, as every second right now matters. And any second questioning his specific language and who it might be referencing is certainly not helpful to this campaign.
Kaylee, how calcified are voters right now? In other words, how much can they be susceptible to some sort of October surprise 6 days out from the election?
Well, the basket we're talking about here, Lisa, is very small. Perhaps at this point, less than 5% of the electorate has yet to make up their mind. And I would point out, given the early voting numbers we are seeing, almost more than a third of the electorate to this point has voted. That's true, and especially some of the battleground states we're watching, like North Carolina, where I spoke with the Secretary of State yesterday and she told us well over 3 million people have already voted. And that is more than 33% of North Carolina's electorate. So a lot of minds already have been made up, which does raise the question of how much messaging from here really could help, whether it was Kamala Harris's remarks at the Ellipse last night or even Donald Trump in Allentown, Pennsylvania. What will be interesting, though, is to see how this does affect turnout from those who may have otherwise been apathetic, chosen to just sit on the sidelines this time around. If you look at Puerto Rican voters in particular, which was what was being referenced in that clip of Donald Trump's interview with Sean Hannity, there's 500,000 of them in Pennsylvania. And even if some of them decide to partake in this process and vote against Donald Trump because of that rhetoric at Madison Square Garden, knowing the margin in Pennsylvania in 2020 was less than 81,000 votes, that ultimately could make the difference. It's not necessarily about getting people to switch their vote, but maybe about getting them to vote at all, to get off their couch.
Hey, Kaylee, thank you. Bloomberg's Kaylee Lynch. You can catch Kaylee every weekday at 12 and 5 p.m. Eastern on Balance of Power. Sometimes you have to call it out for what it is. Ridiculous. At the same time, they want to attribute the words to a comedian, to the former President Donald Trump. They don't want you to believe what you heard. They want you to read the transcript instead.
And the transcript has a very useful apostrophe S talking about actual garbage of supporters in the ocean. But when you listen to it, it certainly does sound like the president is saying his supporters are garbage.
Axios had a report over the weekend that President Biden wants to campaign for the Vice President Harris in the final 9 days. Harris's campaign keeps responding, "We'll get back to you." And I think we had another reason, another data point in the last 24 hours as to why they keep saying, "We'll get back to you."
This time right now is precious for any campaign, and you do not want to put an individual out there, one, that she needs to be distancing herself to win over parts of the electorate, and two, who is gaffe prone. We are 6 days out from the presidential election, and he makes a massive gaffe that some people are saying is equivalent to when Hillary Clinton called Trump supporters deplorables in 2016.
There's a big difference when the president says it and when a comedian does. And I think that's the problem they've got this morning. Terry Haines of Pangaea Policy joins us now for more. Terry, welcome to the programme, sir. You've been saying for a while that Harris has got the edge. A week away, has Harris still got the edge?
Well, I think she's got the edge because I think she does a better job of turning out her voters, and her voters have more enthusiasm, frankly. You know, I mean, the Saturday Night Live writer in me wants to say, you know, Harris should say, I'm the candidate of change. You know, look at last night, right? Look behind me, because look at what Biden's doing right now. I'm definitely the candidate of change. Look at Trump. I'm definitely the candidate of change. But I think on net, she does a better job of getting her people out, and that's you know, and that's the name of the game. It's a trope, but it's true.
Her speech last night was really a lot about democracy, and the polling with the New York Times over the weekend, when you ask about democracy, it's very partisan. If you're a Republican, democracy is important to you, but for different reasons. Those individuals cite voting by mail, electronic voting machines, immigration, even the DOJ. Is that line going to land her sticking point right now? Last night was a week out from the election.
That line does a much better job of playing to her base than it does playing to undecideds, I think, frankly. And, you know, what you see in both of these campaigns, I think, is subtle acknowledgments that they think their base is weak. You know, Harris keeps playing to the base, keeps trying to stoke the base. Trump, frankly, does the same thing. You know, there's not a lot of outreach to the middle here, which is, I think, one reason why Harris barely, I think, ends up with the better of the argument at the end of the day.
Is she able to, in that speech last night and some of her other outreach, is she able to bring on moderates, independents, and potentially Nikki Haley Republicans?
Well, I think, you know, I mean, I'm glad you brought up Haley. I'll get to her in a sec. But you know, the way that these things get, you know, that speech alone, I think, did not, because, you know, the vast majority of it was all about Trump and how terrible he is. And, you know, the unifying stuff came on at the end. Now that stuff gets sliced and diced and put into ads at the very end of the campaign, all that sort of thing. Useful contrast last night, though. Haley gave a long interview to Bret Baier on Fox, and Haley confirmed yet again, I mean, I keep hammering on this, but keep confirming that they've never out-talked to her. Trump hasn't talked to her since June. They're not planning on using her in the campaign at all. You know, they're essentially writing off at least 20% of their own voters, and Trump's campaign is. And I think that's one reason why you have Harris hammering so hard on what I'll think of as the Liz Cheney argument, the idea that establishment Republicans are giving swing voters permission to actually vote for Harris. You know, and I think that on margin, that also helps her.
There's a question Katrina Dudley just raised of Franklin Templeton, that she thinks that the chance of a full sweep one way or another is much greater than people are giving credence to it. Do you believe that that's the case?
No, I don't. The reason why I don't, frankly, comes down to the House. You know, now on the Senate, I will give you, I always say tiny Republican majority in the Senate, but in a world where there aren't a lot of swing voters anymore, I could see the Senate totals going up slightly. Ohio is a perfect example of this, where Trump is comfortably ahead, yet Democratic Senator Brown clings to a small lead. Could Trump voters push Democrat Brown out of office? Sure, that's plausible. But at the same time, in the House, what you have is a situation where there's a really tiny Republican majority today. Democratic hopes of reclaiming that majority have to do with taking back Republican seats in heavily blue states like New York and California. That was something that was on the cards the day after the 2022 election. It doesn't really it doesn't really matter with Harris. So I think what you end up with is about a 70% likelihood of a split government.
Hey, Terry, always great to hear from you, sir. Terry Haines there of Pangaea Policy. This market's starting to lean in aggressively to the Trump trades over the past few weeks, even though the polls have barely moved. We'll catch up with Citi a little bit later on this morning and think that maybe it's time to take some of those Trump trades off the table. Up next on the programme, we'll catch up with Scott Devitt of Wedbush on Google's better-than-expected earnings, with Meta and Microsoft results on deck. From New York, this is Bloomberg. Equity futures on the S&P 500 up by 0.2% after the first back-to-back gains on the S&P 500 going back about 2 weeks. Big tilt to mega-cap tech going into earnings in yesterday's session. The Nasdaq Composite at all-time highs. The Nasdaq 100 up by 0.2% this morning. Alphabet numbers really pretty decent, opening the door to more of the same after the ballot a little bit later.
Sales rose 15% year over year. You take a look at cloud revenues coming in at $11.4 billion versus the estimate of some $10.8 billion. They are gaining share and they are seeing better ad revenue than they thought. All at a time when people were saying, well, can they really beat that much? Well, the answer is yes.
That's the equity market. Here's the bond market story. Yields declining for a second session, down a basis point at the front end, down 3 or 4 at the longer end on a 10-year, 421.82. Do you put more weight on jolts, job openings, or do you put more weight on consumer confidence? Or will we put weight on the totality of the economic data a week tomorrow?
Actually, yesterday, I would put complete weight on the 7-year auction. I know that you might say, really, Lisa, you're going to bring up the auctions, but that came in so strong. It was actually one of the strongest auctions that we've ever seen in several metrics. So you start to wonder, oh, wow, there's actually demand for some of this long duration paper, even some of the less loved durations like 7-year. That gave people confidence that some of the other economic muddle didn't.
After a soft 2- and 5-year auction to kick off a trading week. That's the bond market. We'll shift to foreign exchange. The euro looks like this, sterling as well. The euro positive by 0.2%, 108.37. That move in bonds just taking some heat, bringing down the temperature for the US dollar. Euro dollar positive by 0.2%, and pound sterling one to watch, 129.84. Just some times for you. So at 8:15 Eastern time, we'll start our coverage in the UK of the British budget. So if you're in the United Kingdom, that's the coverage that you'll be watching. At 8:30, we'll take that budget in full. So that's 12:15 and 12:30 local. The budget, a big one for Chancellor Reeves a little bit later this morning.
Yeah, talk about the difference in tone between the U.S. and Britain. We're going to be hearing about cuts. We're going to be hearing about restraint. We're going to be hearing about anything to avoid a Liz Truss moment, whereas in the U.S. it's saying basically the purse strings are open. It's just a matter of how much we're going to end up spending.
Absolutely, and that's why you see bond yields going up and some people saying it doesn't really matter. Yes, this is a Trump trade, but regardless, either party is going to be spending. Maybe Trump spends more or inflation is higher because of tariffs. But look at what's on the campaign trail from both of these camps. We're talking about payment on down payments of houses and basically every tax cut under the sun.
As we often say, the privilege of behaving recklessly, a privilege the UK does not have. Under surveillance this morning, Boeing and union leaders representing 33,000 striking workers holding productive talks. The union saying the two groups addressed key bargaining issues in a face-to-face meeting with assistance from Acting Labour Secretary Julie Su.
Julie Su doing a lot of work. She was part of the last negotiation as well. She is really trying to get this over the finish line, especially, I think, ahead of the election. 33,000 workers still remain on the picket line. They are not getting paid. They are not getting health care benefits. I go back to what the vote count was prior. 35% wasn't able to get it done. 64% in terms of a raising of those wages by 35%. 64% of the union workers said no. When it was 25%, 95% said no. They're asking for 40. Is that where Boeing has to go?
I just want to know when they're going to start making planes again. I want to get some new planes.
When the workers get back.
Well, honestly, I would like to see some new planes in the air because I've seen a lot of old ones. And I would just say it makes some concerns and it raises delays because of the maintenance that needs to get done.
How old are these planes?
I mean, not
like the ones with the ashtrays in.
Well, they all have. Before. I actually looked that up. They all have to have ashtrays. It's a mandate from law, which is some relics of some other era.
They've got to have ashtrays.
Yeah, there needs to be at least one ashtray to actually pass through the regulations. I looked this up after you said this.
I've never heard of that.
That's the reason why they're there.
Is that actually a real thing?
I'll look it up again.
Okay,
but yes.
Please do. Love that story. Never heard of that. All right. Boeing is up by about 0.2% at the pre-market. Got to double check that fact. OK. Volkswagen posting its least profitable quarter since the pandemic. Operating profit plunging 42% in the third quarter. The results coming as the automaker plans drastic cost-cutting measures out of Germany. I've asked the question we all have. Have we faced this kitchen sink moment for this manufacturer and for this industry in Europe?
The fact that the shares are up suggests this might give them the wherewithal to actually go ahead with some of these cuts, which might be the beginning of the kitchen sink moment. We shall see. I mean, it's up, what, 0.5 percentage point after losing some 20% so far this year. So this is early days.
The Mercedes-Benz CEO recently called it our Darwinian battle. That is what this industry is facing right now. Look at the margins on VW brand. It is the core. That's where all the costs are coming. 2.1%. Tesla is double digits. You are getting absolutely crushed. You cannot remain competitive with margins that low.
This will be a class in public policy courses for decades. How not to run the government in Germany. For the last 10 years, it's been pretty terrible.
Yeah, although they did just avoid recession, so there was better than expected data. They didn't shrink, and I guess that people are cheering on that. But you're right. What's the plan going forward for growth? And really, the stark differential between what we're hearing out of European governments and the U.S. is just pretty remarkable.
VW up by 0.6%. Elsewhere, Alphabet shares rising in the pre-market after the company reported third quarter results that beat expectations. Big spending on artificial intelligence starting to pay off, with costs for AI-boosted search falling 90%. The stock, Lisa, up by close to 6%.
So here's my question. Are they taking share away from Amazon and Microsoft? And I guess we're going to find out in the next coming days, today included, with some of the earnings that are going to be coming out. But this was sort of the behemoth that they were trying to get into. Can they basically say their AI makes their cloud superior at a time where that's been one of the main profit drivers for all the big tech companies?
Confirmation from the control room. Even though smoking is completely banned on U.S. flights, airplanes are required by the Federal Aviation Administration to have ashtrays on or near the lavatory door for the very simple reason that some people still try to smoke on board.
Yeah.
Isn't that absolutely shocking? I was talking about really old planes that have got like the ashtrays by the armrest for the passengers. But I didn't know this at all.
You once called me out. You said, well, yeah, what you're talking about. I saw an ashtray in there. That's outrageous. And so I looked it up. And
well, I was talking about really old planes because you used to be able to smoke.
Flight.
Like, I'm talking like decade. You know the planes I'm talking about.
I know definitely those planes you're talking about. They actually serve very good food, but they do have tons of ashtrays. I have actually not seen an ashtray on a plane in ages, and now I'm going to look out for one.
We're going to look for that, aren't we? I actually wanted to talk about Alphabet. There was something that stuck out in the earnings for me yesterday, and I think it stuck out for us all. Coding. More than a quarter of Alphabet's new computer code is written by AI. How big is that? And how much bigger could it be in just a few years' time?
Yeah, and you raise this point with respect to as companies get bigger in sales, do their staff stay the same or even shrink? How much are we looking at that? And actually, when you take a look at the JOLTS number, and this comes from Bespoke, you could see that the biggest decline in job openings was white-collar jobs. Are we starting to see this happen where basically there are certain roles that maybe are less intensive or skill-oriented that are going to get eliminated or at least changed as this transformation takes place?
The CFO said it yesterday. The company plans on building on more cost-cutting efforts around AI streamlining, to your point, Jonathan, what's going on with these engineers, and manage headcount and the company's physical footprint. It's a really big question going forward.
I really worry about youth unemployment and how far behind the colleges are in this story. The college graduates right now, they're still being told, don't use this stuff, don't use it. But when they're going into the private workforce, they need to know how to use this. They need to get good at prompting and get good fast.
So, as the mother of two kids who will be part of the youth, hopefully, employment market, I do think that at this point, the focus is starting to shift. And you start to see that with respect to papers and how they incorporate AI, how they sort of come up with sort of critical thinking overlay to use that. And that has to be where that moves. I'm going to stop about PSA, about the importance of education, but I'm just going to sit back now.
It's got to happen quickly. I'm on board with you. That stock is up by close to 6% in the pre-market. Tech earnings rolling on with Meta and Microsoft reporting after the closing bell this afternoon. Scott Devitt of Wedbush expecting results to keep up the momentum, raising estimates on Meta and keeping an outperform rating on Microsoft. Scott joins us now for more. Scott, before we push on, can we just reflect on what we heard from Alphabet? How impressive has this turnaround story been for that company this year? At the start of the year, there was a feeling that they were out for lunch and OpenAI was eating it. Scott, now we're about 10, 11 months into the year and there's a feeling that they're on top of this story. Do you share that confidence?
We do, and I think that what you have is this kind of rolling narrative on Alphabet of whether AI is a net positive or a net drag on the business. And our view is that over the long term, as Alphabet builds in AI capability and benefits from AI in its cloud business, it ends up being a net positive. And as you've mentioned on the show already, the ability to refine the business model and cut costs as the company invests in AI as well allows margins to rise as they're investing in the new thing. The stock trades at under an S&P multiple for a business that's still going to grow double digits with operating margins that are expanding, which is about 2 times the rate of the average S&P company.
So there are two aspects to this, Scott. And it's one thing that John brought up, which is essentially, are they going to have a much smaller staff, even with a bigger business, because of some of this cost-cutting measure? And I want to ask that first.
I think that's plausible. What you're going to end up having is engineers being moved into other activities that are more value add. But with that, as the company continues to grow, I would assume that they can be much more efficient in adding new heads to the mix, given the commentary on the call last night and just the natural evolution of AI. And that's a very positive backdrop for Alphabet, because they've been notorious for running less lean than other internet companies. And so the ability to kind of take that incremental capital, whether it's operating expenses that are not labor related or engineering related talent becoming more efficient, gives the company a tremendous amount of money to spend and kind of hide that investment in AI as they make this transition.
So that leads to the next question, which is how much of an upper hand are they getting versus Microsoft's Azure or Amazon's AWS? How much are they actually eating into their competitive advantage when it comes to cloud services because of the AI component?
Well, Google Cloud added $1 billion of revenue on a sequential basis for the first time in history, as far as we can tell. They beat expectations for growth by 600 basis points. So it was definitely a strong quarter at GCP. What I would say is that, AWS and Azure both have very strong platforms as well. And I think it's more of an indication that the category, AI and cloud, are doing very well as the economy is recovering. Versus Alphabet taking significant share. Now, because Alphabet's the smallest in the category from a percentage basis, it will show that it's gaining share. But in terms of absolute dollar volume growth, I think you're going to see Azure and AWS have very strong quarters.
Scott, what's going on with search? Because volumes go down. They have ChatGPT, a huge competitor, but actually they're still making money off of it, and a lot.
So I think we've gone through this kind of evolution a few times with Alphabet over the years. You had Amazon Prime launched in 2005. Investors thought that would be problematic for Google search. You had Meta, which went from zero to over 200 billion in revenue over 14 years, going back to 2010. And Alphabet's kind of survived and weathered that. And now you have AI, which is likely bigger than those two, but ultimately, Alphabet's going to morph its model for it. It has a data set that allows it to position, for continued growth. And I think we'll survive this threat as well. And so there's a lot of sensationalization that happens, during this time. And I think Alphabet's a very healthy company, not, the next Yahoo eBay, as I think it sometimes gets positioned when being discussed.
What are you expecting from Meta this evening? They've had a massive push into the AI space.
Moderating growth, but better than expected, and towards the high end of the 13 to 20% revenue growth, with some discussion around spending for AI, but in a very positive manner, as Zuckerberg talks about the commercialization of the technology. And so I think it will be well received, and I think the Alphabet advertising results, bode well for Meta to actually surprise positively as well.
Scott, just to wrap it up, I'd love your thoughts on leadership and how they're handling the upcoming election. You remember that Mark Zuckerberg, in an interview with us a number of months ago, referred to the assassination attempt on Donald Trump and his response to it as badass. And then we've heard several reports, including from Donald Trump himself, that some of these leaders have called him, including the Alphabet CEO, who suggested that the McDonald's campaign effort over the last few weekends was one of the biggest hits they've seen on Google. What do you think is happening there? The diplomacy that we're starting to see from Silicon Valley towards the former president?
I think the industry's growing up and learning how to operate in a political environment with information that flows freely in ways that, it's 8 years more mature than the last time around. And so I think it does bode well, for the future, and I think it's a positive move for the technology industry.
Scott, appreciate it, sir. Thanks for your time today. Scott Devitt there of Wedbush on the latest. Alphabet numbers just out yesterday. Meta, Microsoft coming up a little bit later. We got numbers from Caterpillar just moments ago. Caterpillar is down in the pre-market by 6%. It's a miss on revenue, lighter on EPS, and the outlook, Lisa, not great.
Yeah, weakening demand in construction around the world, which is really a question because this goes to this debate that we've been having that maybe they'll have all this reinvestment in industrial sectors, in metals and mining, and some of these other core areas necessary to really build out energy infrastructure. Why then is Caterpillar doing so poorly? Is this international or is this the U.S.? I actually want to dig a little bit further into the results.
The stock is down in early trading by about 5%. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Another earnings result for you. Shares of Reddit surging nearly 24% in the pre-market. The social network sales and forecast beat expectations. Shares also had already more than doubled in value this year, even before the report. The company's been investing in advertising tech to help better monetize its large audience. The results suggesting that those efforts are paying off. Elon Musk's artificial intelligence startup xAI is said to be seeking new funding at a roughly $40 billion valuation. A source says funding discussions are in an early stage and the details could still change. Musk says he aims to double the compute power of his startup's training cluster in Memphis, which he claims is already the world's largest. The Supreme Court has denied to remove Robert F. Kennedy Jr. from ballots in key swing states of Wisconsin and Michigan. Kennedy had sought to remove himself from the ballots after pledging his support to Donald Trump. The states argued that removing his name is impossible at this point in the race, with over 2.5 million ballots already cast between voters in both states. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, taking Trump chips off the table.
Enacting real policy change, we know, takes time. So despite the rhetoric, first of all, we think, checks and balances remain in place on whoever gets into that presidential seat.
That conversation up next. S&P 500 futures positive by 0.06% coming into Wednesday. The Nasdaq Composite at all-time highs. Some of these trades in the FX market, dollar stronger, dollar weaker. Today, off the back of this move in the bond market, yields lower by 3 basis points. The 10-year 421.82. Under surveillance this morning, taking Trump chips off the table.
Enacting real policy change, we know, takes time. So despite the rhetoric, first of all, we think, checks and balances remain in place on whoever gets into that presidential seat. Probably that means some of the more extreme proposals are going to have more difficulty being passed. And so the real changes on the macro narrative will come around areas like taxes, perhaps on the tariff front, and maybe in terms of even immigration policy longer term.
So here's the latest. As many investors lean into Trump trades, some warnings begin to build. Citi suggesting it might be time to take profits. Dirk writing, despite investors concluding that Trump would be the victor, the polling bias is only moderately in his favor. We therefore take profits in some of our Trump-biased election trades. Dirk joins us now for more. Dirk, welcome to the program, sir. Let's get into those trades first of all. Which ones would you take off at the moment?
Thanks for having me on. I think there's a lot of consensus among investors that Trump has already won, right? And almost every pollster think, listen, it's really very close to call still, and therefore it's not really a foregone conclusion, even though the odds are slightly in his favor. So the trades we decided to take off are one, our long break-even trade. As you know, there's a lot of concern that Trump administration would mean more inflation. Actually for several reasons, because of the immigration policies, because of the tariff policies, and because of fiscal expansion. And so the inflation market priced meaningfully higher pretty much across the curve. And we think that is really quite mature, and that could have a meaningful backlash if Trump still were to lose. And therefore, we think that is really one that we would take off. The other one is in the dollar. People really piled into the dollar. And of course, they piled into it for two reasons. One, because the macro changed. This NFP was very strong, and that changed the sentiment around the dollar. But the second thing was, of course, Trump. Again, tariffs being bullish Trump, fiscal policy being bullish dollars, fiscal policy being bullish dollars. And that is also quite a mature trade. And so we took off our euro downside structure.
Dirk, that's what makes it slightly more complex. we need to figure out what was driving the trades to begin with. Why do you believe this was more about Trump's prospects than just about fundamentals, the economic data, and monetary policy too?
It is true. It's almost impossible to figure that out fully, because even if you say, well, the dollar just moved with rates, rates moved with Trump, right? And so what is somewhat hard to say. But I would say the extent of dollar buying that we've seen was much more extreme than what you typically get if it's just an NFP print or if it's just a change in the economic outlook. It really was really quite large. You can also see where it happened. Investors bought most in dollar China. Dollar China is, of course, the single biggest Trump trade that there is. It's now a very big consensus trade. Now, I would say we have still a structure that would benefit from higher dollar China after an election. And we kept it. And the reason is that I think the PBOC is really a little bit an investor's friend in calming down the volatility, in making sure dollar China doesn't overshoot too quickly, too fast. And so I think investors are still able to add to dollar China for that reason. But in general, to answer your question, where this dollar buying happened is a clear indication that a lot of it had to do with Trump.
How many of your clients or your compatriots, Dirk, are curious about playing in the Trump media and technology group in Bitcoin?
I don't cover single equities. Bitcoin is, of course, also a Trump trade, and it's a little bit similar to gold. Gold also had a very strong move, of course. Now that gold is a Trump trade is really quite curious, because usually, and the same is true to some extent for Bitcoin, if rates go up and the dollar goes up, that's a terrible environment for gold. Now, this time around, we have rates go up, dollar go up, and gold does great. And the reason is, of course, again, these inflationary fears with the Trump administration. And even more so, it's inflationary fears with the Fed not going to do much about it if there was a higher inflation. And the combination of higher inflation and a dovish Fed is, of course, a great environment for gold and also for Bitcoin.
Dirk,
so I think that explains a little bit the paradox.
Dirk, why do you think the financial markets are taking their cue from the betting markets and not polling?
I mean, I think what is happening is that markets love momentum. Right. And the polls, they are, of course, have moved in favor of Trump. They have showed some momentum, and people just ride that forward and they jump on the momentum train. And that is what we see in markets all the time. And that's, I think, how people use the polls. And it might be right. I mean, there is some momentum in polls, and that is what we're seeing. And, you know, at this stage, Trump, of course, has the upper hand. And I think that is clear both in polls and in betting markets. But the extent to which he has and the confidence we can have in the outcome, I think, is somewhat exaggerated in markets.
Hey, Dirk, appreciate your time. Thoughtful piece. Thank you, sir. Timely, too. Dirk Willems of Citi. I've read this a few places now in the last few days that we're vulnerable to a snapback the other way, particularly, of course, if Harris wins and Trump doesn't.
Yeah, or even if there isn't that much uncertainty following the election. Goldman Sachs came out and was talking about how people are overplaying the volatility, even if we don't get some sort of definitive answer as to who the president is going to be.
Neil Detter wrote this over at Renmark just yesterday. How much of this is the politics, the Trump trade? How much of it is just the data? We calculate that almost 40 basis points of the move in 10 since September have occurred on days of strong economic data. A strong suggestion there that it's the data more than maybe it is the politics. Coming up next on this programme, Jack Caffrey of JPMorgan Asset Management, Charles Mars of Signum Global Advisors will catch up with Bloomberg's Trade Trudeau, and we'll speak to Clete Willems of Akin from New York City with futures just about positive. Alphabet up nicely and cap down in the pre-market. This is Bloomberg.
Neither candidate has really expressed any interest at all in deficit reduction.
Whoever wins, I think they better hope for divided government.
I think that if this were sort of a generic Republican, this race would probably be over. A Harris win at this point, I do think markets would be surprised.
The two candidates are going to be separated by as few as 10 or 20,000 votes.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
A huge focus on the earnings after the bell yesterday and through this morning. Before we get to more economic data, tomorrow we'll get jobless claims. On Friday we get payrolls. After the bell later, Meta and more earnings from the Mag 7. Equity futures on the S&P 500 up by close to 0.1%. The Nasdaq 100 up by 0.2. The Nasdaq Composite coming into Wednesday at all-time highs after Alphabet knocked it out of the park.
There's been a question of how much more can big tech continue to outperform, and the answer is quite a bit. And evidently there is even more to do, and potentially even with job cuts, as you pointed out, or even fewer staff, as they continue to push into their dominance of cloud and just AI in general. Question here is, are they taking away from each other, or are they just the incredible overlay of growth that's really driven this entire market?
Sundar Pichai opened up the call with this. Company's full stack of AI products is now operating at scale and being used by Google's billions of users, and what he calls creating a virtuous cycle. AI for them is starting to pay off big time.
After the bell, we'll hear from Microsoft and Meta tomorrow, Amazon and Apple. These are long-term themes. Let's talk about some short-term issues. Caterpillar is down in the pre-market by 4%. It was lower than that. It's a miss on the top and bottom line, and the outlook is not much better either. And I just wonder how much the election uncertainty is playing into some of these stories we're seeing this earnings season.
If you look into the details, when you strip out the AI themes, the building out of the energy infrastructure, things were very weak. How much does this speak to the industrial recession that we've seen for quite a while? And how much is this exactly what you're saying, which is a hesitancy on making some big moves ahead of the election?
What I find interesting then, if you go back to the conference board yesterday, Dana Peterson talking about this, in October, write-in responses about politics, including the election, were unchanged. We've seen a buildup of people writing in this consternation and concern about the election, maybe waiting on the sidelines, worried about what that means for jobs, wages, inflation. And they say below both 2020 and 2016 levels. Maybe the American electorate is just so over this.
The labour market data and the conference board data, the consumer confidence numbers yesterday were really mixed and quite confusing. I think Lisa absolutely nailed it a little bit earlier on the programme. That the most encouraging thing for the bond market yesterday was that the 7-year auction got bought after a soft 2 and 5 at a time when people were worried about a buyer's strike. This morning yields are lower again on a 10-year. We're down 3 basis points to 4.22. But when you get into the economic data, the contradictions. The September JOLTS report, I don't think you can overstate this, runs completely counter to the strong non-farm payrolls report we saw for the same month.
Yeah, you saw JOLTS come in with both firing and hiring picking up just marginally, but the quits rate, which people look at as people's confidence that they can get another job, falling to one of the lowest rates that we have seen, even when you strip out the pandemic, going back to 2015. So it raises this question, are we seeing strength? Is this a normalization, or is this something that really does speak to why the Fed is still cutting rates, even though you have some people saying it's a no landing and inflation is going to go to the moon?
But for the JOLTS, the conference board, shares of consumers that say jobs are plentiful rose. Share of those individuals that say jobs are hard to get decreased. That metric is now the widest it's been since January, which actually shows that signs that this is a very healthy labor market. So this totality of data doesn't really make a lot of sense.
That differential had been deteriorating through most of this year and then suddenly improved. Make sense of all of that if you can. The 2-year at the moment down a single basis point. It's a break of 4.1%. Coming up this hour, we'll catch up with Jack Caffrey of JPMorgan as tech earnings lift equities. We'll speak to Charles Mars of Signum on key voting demographics for Harris and Clete Willems of Akin on Trump 2.0 economic policy. We begin this hour with stocks inching higher as strong Google earnings support equity markets. Investors now looking ahead to Meta and Microsoft. Jack Caffrey of JPMorgan putting the emphasis on corporate results. Earnings need to deliver now and into next year against a setup of earnings already expected to accelerate. Earnings matter, with the overall market valuation likely capped by a 10-year yield that has sold off by 50 basis points over the past month. Jack joins us now for more. Jack, good morning. Good to see you. Let's start there. That relationship between the bond market, fixed income, and the equity market and what's happening with stocks. And more pointedly, maybe the relationship between the Nasdaq, with the composite at all-time highs and bond yields pretty elevated. Does one speak to the other?
They, at least academically, they have to speak to each other in terms of thinking about what a discount rate is. When we think about the NASDAQ, historically we would have thought so much of the NASDAQ was delivering its earnings into the future. When we look at results last night, perhaps later tonight, hopefully, we're bringing those results into the here and the now. And so there is a NASDAQ which has got a large number of unprofitable companies, and you have a leadership where you talked a bit earlier about the Magnificent Seven, which I would suggest more recently has been more of a meh 7 when you look back over their lack of progress Any one of them has like a great week or two, and then two others are sort of putzing along doing a whole lot of nothing.
There was nothing there about the numbers yesterday afternoon after the close for the numbers from Alphabet.
Well,
there were some worries about the CapEx spend, and it feels like those worries have been buried. Should they be?
I think people have made peace with the amount of CapEx over the next year or two, but there are certainly some projections for massive CapEx continuing to ramp over 2 or 3 years, and I don't know that I've seen the same expected profit growth out of those people expected to spend that money. And yesterday was a bit of a tale of two cities, because you had great news out of Alphabet. You had certainly more uncertainty around AMD, which has certainly tied itself to the AI trade, has tied itself to look at how large the market's going to be, and maybe we're going to be back into this more narrow stock selection tape that we've been talking about wanting to have all year, rather than just saying, if you deal with obesity or AI, hop on.
All right, let's run with that. And obesity is another point, because Eli Lilly is actually falling because they didn't do as well with some of their weight loss drugs. But this idea that you can have this concentration that continues to generate big gains for the overall index, even if the underlying components aren't, how much are we seeing that with respect to the outperformance of Google and the underperformance of the likes of Caterpillar? Outside of these issues of AI development and the infrastructure that comes around it, are we seeing that bifurcation continue, which makes this economy very, very confusing to understand?
I wish it were easier. I would sleep better. But the reality being, we almost wind up having to take individual themes apart. So AI works, and I think one of the reasons why AI continues to work is the customers for the underlying technologies are profitable. Understanding how those customers are using that AI to drive revenues and drive earnings, that's been trickier, and I think you've seen some pressure on some of the AI consumers rather than the AI beneficiaries. We have an election in a week. I'm sure we've all heard that.
Less than a week, but yeah.
Vote early. But underpinning that election is going to have issues for labor supply. Underpinning that election is going to have issues with respect to paths of inflation, for some of the underlying heavy industry spending that's been on pause for, call it 2 years, when we look at how bad the PMI has been. And so when some people are thinking, do I want to spend money? When I've been with you over the past several months, we've talked about, are utilities a growth stock or are they a defensive stock? Well, utilities building out the power for AI, they wind up eventually needing either backup power, which winds up feeding into a Caterpillar, building data centers, so I need more bulldozers to extract gravel to lay the foundation. But if you're not sure what's going to happen, it's kind of easier to say I can get to it in a week or two. It doesn't feel like I have a backlog I'm fighting through the way I did in 21 when I'd pay anything for a piece of a widget today.
Which is the reason why I think a lot of people have been looking into single name stocks and to pick those specific stories. But when you take a look at the macro themes, because of that, people are saying stocks in some ways are going to be less volatile than bonds when it comes to the election. What's the relationship at this point between bonds and stocks?
Well, I think in the shorter term, this idea that stocks are cheap, we can't really make that case anymore. The equity risk premium has certainly chipped away. I think equity investors have looked to credit markets and say, look, credit isn't sensing a problem. Yield spread or credit spreads are back to tights of 21. So nothing to worry about. I don't have a profit worry in the immediate future. I do think that credit spreads tighten, not the good way, as in people bid up credit, but it's more that the yield market sold off. And I think it will come back to, why are yields rising? Are yields rising for good reasons, like the economy's booming and we have 5% real GDP and an ample employment gains? Real wages are certainly up and catching up, although people don't seem to feel it right now because price levels remain elevated even if they're not accelerating higher. Or are yields rising because we wind up seeing a path that might cause more economic shocks? So I think the bond market is keyed in more to what may happen on Tuesday. Realistically, it might take several days after Tuesday to figure out who actually won, and recount and litigate. I think election lawyers are going to do really well in the fourth quarter, for those looking for a short-term job posting. But ultimately, at some point there is a relationship between what do I get from a bond, what do I get from a stock? And right now, 10 years ago, you could have out-yielded bonds by owning equities. Today, the dividend yield at 1.5%, not necessarily competitive with the 10-year.
Jack, I want to go back to what
Sorry.
you said about businesses and investors maybe waiting on the sidelines, waiting a week out, seeing what the election results are going to be. Do they need just clarity, or do they actually want to know who is going to be in what positions to understand policy?
Well, people are policy. So to some extent, we have to sit back and think, what do majorities look like? So who is confirmable, who's not confirmable? You know, we've had some interesting names floated in terms of having very interesting and, dare I say, influential roles in government, some of which I admit would terrify me, going through that. And,
like who? You really want him to get into it?
Both sides?
I think that I'm more likely to get continuity out of a Harris administration going forward. I don't really know that I want to eat roadkill.
Harris administration, even with a blue sweep in Congress, or Harris administration with gridlock in Congress?
I think Harris with gridlock, you get very little change because people who are in seats will probably stay in them under concerns that they would not be confirmable. And by divided Congress, I think you just mean a Republican Senate, because ultimately they are the gatekeeper.
Is this your base case going into Tuesday?
Certainly the polling would suggest the likelihood of a Republican Senate is the greater certainty. But, you know, I look at, no one's responding to polls anymore, so it feels like I can't really rely on those. Now we've suddenly leaned into betting markets, and we realize that there is the equivalent of, well, we had the London whale in credit, so now we have the Paris whale influencing the betting markets.
Do you believe that regardless of the outcome, if we get an outcome,
we will get an outcome.
We're going to get an outcome within the next couple of days.
Some large number of people will be unhappy.
Okay.
That I think I have high confidence.
Okay, so then do you think that there will be a relief rally if we have an outcome within 4 days of the election, 3 days, 49 hours?
You know, I'll come back to, if we go back to 2016, you had an immediate sell-off and then suddenly realized, wait, not only did we get a very surprising presidential outcome, but then we wound up giving unified government. And we had a presumption of what policy might look like in that unified Republican government. Paul Ryan had been very clear with what he would have liked to achieve with control. And so you got that rally off of what would have been sort of traditional Republican policies. The Republican policies today are different than the Republican policies of 2016. And I think trying to understand what's a press release, what's a meme, and what is actually implementable remains a big question. But I would be not surprised if we see, you know, a rally one way or the other. Maybe a rally depends on if you're a bond investor. Yields collapsing would be a rally. But I think it's interesting to say, look, from January up until July, implied equity volatility never touched a smooth measure of equity volatility. From second quarter earnings on, equity volatility has never actually dropped below that smooth 200-day moving average of equity volatility. So equities remain really twitchy overall. And so I think we have to respect the fact that, you know, investors have strong views that are being very lightly held in terms of their willingness to embed them. You know, fixed income vol have been on a nice, long, steady decline and really spiked higher over the last month. And you're back to, wow, fixed income investors have an investment horizon of about tomorrow's jobs report, tomorrow's unemployment report.
Jack Caffrey of JPMorgan looking for a boost to job openings after the election next week in a very specific part of the labour market. Jack, it's good to see you. Thank you, sir. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of Eli Lilly tumbling 6.5% pre-market this morning. It lowered its full-year guidance. Sales of its blockbuster weight loss drug, Zepbound and Mounjaro, both coming well short of forecasts. Lilly blamed inventory issues for the miss. Shares of rival Novo Nordisk also turned around and are falling in sympathy this morning. Toyota sales are falling in the carmaker's home market of Japan as well as China. Toyota is struggling to shake off a series of challenges, rising competition from EV brands, domestic scandals, and recalls abroad. Overall global vehicle production fell over 8% in September compared with the previous year. Shares of Donald Trump's social media company, those are also falling in the pre-market. But the stock has rallied for 5 straight weeks, polls showing a neck-and-neck race between him and Vice President Kamala Harris. The rally has added more than $7.9 billion to the company's value. Trump's paper gain in the company, that is up near $6 billion. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 13 minutes' time. Up next on the program, the stakes are high.
These United States of America, we are not a vessel for the schemes of wannabe dictators. The United States of America is the greatest idea humanity ever devised.
That conversation up next, live from New York. Good morning. Equity futures on the S&P 500 positive by 0.1%. Bond yields just a little bit lower. We're down 3 basis points, 421.82, after having a little look at 430 in the last 24 hours. Under surveillance this morning, the stakes are high.
And those who came before us, they did not struggle, sacrifice, and lay down their lives only to see us cede our fundamental freedoms. We are not a vessel for the schemes of wannabe dictators. The United States of America is the greatest idea humanity ever devised.
So here's the latest. Kamala Harris attempting to paint the former president as a threat to democracy as markets begin to price in a victory for Donald Trump. Charles Myers of Signum Global Advisors is pushing back, writing broad consensus out there is for a Trump win. But financial and betting markets have a pretty poor track record of predicting election outcomes. We still believe Harris gets over the line with higher turnout by women, black voters and young voters. Charles joins us now for more. Charles, welcome to the programme. Can we just start with what's behind this move in markets, where that comes from? What do you think is underpinning it?
Yeah, look, I think it started about a month ago when Harris peaked in the polls and relatedly, Trump started to get momentum. It was a combination of everything from Bobby Kennedy's endorsement of Trump, one of the unions not endorsing Harris, Governor Walz's weak debate performance, and lastly, President Trump finally gaining his footing again and attacking her on policy, on border, on cost of living. All of that happened around the same time. She peaked in the polls. He started to gain. The betting markets initially took off. Now I would argue the financial markets, the Trump trade is back on. And where we come out on this is, polling is tied. They're literally tied in the swing states. She's actually ahead nationally. The markets, whether it's the equity market, the Trump trade more generally, or the betting markets, have gotten way ahead of themselves. This is still a toss-up, and the markets are pricing in a decisive win.
If the polling, Charles, for Harris is being underestimated, where is it coming from?
Well, I think it's a couple things. Polling, because pollsters got 16 wrong and 20 wrong in many ways, including underestimating Trump in both those instances, although in the end he lost in 2020, there's a real possibility that polling companies have overcompensated in Trump's favor to not get it wrong or underestimate him a third time. So what's interesting is I think that polling may be actually overestimating Trump. The reason Harris has done so well is that she's come out the gate, unified the Democratic Party, and has been running on a message of women's reproductive freedom and defense of democracy, as well as the opportunity economy. It's a pretty broad, pretty compelling message.
Yesterday, she ended her speech trying to be a unifier, saying she wants to bring bipartisanship back, and she wants to hear from all walks of people. Then at the same time, you have Biden calling Trump supporters, even though they're trying to walk back this cleanup job, he's calling Trump supporters garbage. Is that going to hurt her in the final stretch?
Well, look, I think it was a really poor choice of words. I think anytime you attack anyone's base or even any group of voters, as, by the way, was just done Sunday at the Madison Square Garden rally, where some of Trump's speakers and comedian really went after some parts of the overall base. I think anytime you do that, it's not helpful. It's not constructive. But in the final stretch here, like almost every American's already made up their mind. We've already had 53 million Americans vote early. I'm not sure that Biden's comments are going to change anyone's minds in this last, 6 days.
I'm glad you brought up Madison Square Garden, because Trump yesterday had to talk about that comedian who said Puerto Rico was garbage. And there's 300,000 Puerto Rican voters in Pennsylvania alone. When you look at some of these unforced errors from both these campaigns, where can it hurt the most?
Well, where it hurts the most is when you go after a very specific group, especially a racial or ethnic group. I do think the damage from the comments around Puerto Ricans, Latinos, and even some pretty offensive comments about black people at the Trump rally, it could hurt a little bit. Where you'd see the impact is it might drive turnout by some voters in those demographics that maybe we're just going to sit it out. So if in the end we see higher turnout by Latino voters in the swing states, higher than expected, then I think that's where we will have seen the impact.
Charles, can you talk a little bit about the gender gap that we have seen as one of the hallmarks of this entire election season, the idea that men and women have never been more divided in terms of their support for each candidate? What does that mean when it comes to who turns out for voting?
Yeah, this is the central question. And again, I do think it's something that the markets are missing as they're pricing in a decisive Trump win. You know, if you look at early voting, first of all, we're going to see very high turnout by women. And what we're seeing so far in early voting is that women are turning out at 54% versus men at 44%. That's consistent with the turnout, the percentage turnout in 2020. If this 54 to 44 holds, Harris wins because that's how Biden won, was higher turnout by women. We think actually within the 54% of women that have so far voted and ultimately will vote, we think the breakdown will be about 55% women, that actually this cycle more women within that percentage will vote Harris or Democratic, and she's going to win, therefore, in the Electoral College. The reason is just very straightforward, as everyone knows. After the Supreme Court decision overturning Roe, 41 out of 50 states have imposed a partial or complete federal ban on abortion access. This is such a big issue on the ballot. It's also how the Democrats outperformed in the midterms 2 years ago, which, again, based on polling, betting markets, and everyone else in our world in financial services, were convinced would be a Republican sweep. That did not happen because of higher turnout by women. If Harris wins this in a week, it will have been higher turnout by women, in large part because of the reproductive freedom issue.
At the same time, the Trump campaign is wise to this and has been trying to encourage people to vote early and to really get the base energized to go vote. We're seeing signs that that's actually having an effect when it comes to early voting in a number of states. How much does that change the calculus against Harris?
Yeah, look, I know that while President Trump took, credit at every opportunity for the Supreme Court decision for a very long time, he realized that now this election, it's turning in, as it did in the midterms, turning into a massive liability. He can't run fast enough away from this, from what the Supreme Court did. The truth is, trying to nuance his position on this, voters see through it. American women see through it. I don't think he's changing any woman's mind about voting because they suddenly think he, or even worse, the Republican Party has shifted their position. The official position of the Republican Party is a ban on abortion. They would put in, as many bans as possible. I don't think that, and I think everyone sees through that.
Charles, just quickly here, you believe that's the official position of the campaign? Because that's not what we hear from Donald Trump or Senator J.D. Vance on a campaign trail at all.
Well, I think what they're trying to say is by, excluding a federal ban on abortion and actually not mentioning anything about marriage equality, therefore it's not part of the party platform. But if you actually, really dig deep into everything they stand for, everything they've called for, I think every American voter believes that they would continue to allow states and support states imposing more restrictions around access to abortion. I don't think anyone believes for a moment the Republican Party's changed on this position.
Certainly not if they keep losing elections, that's for sure. Charles, thank you, sir. Charles Myers of Signum, Global Advisors. Up next, Bloomberg's Craig Trudell. The first back-to-back climb on the S&P 500 in around about 2 weeks. On equity futures right now on the S&P, we add just a little bit more weight to that rally, up 0.1%. A tech-led rally this morning with Alphabet absolutely flying at the pre-market. Nasdaq 100 is up by 0.2%. 2 hours away from the opening bell with your morning movers. Here's Manus Cranny. Hey, Manus.
Jonathan, a very good morning to you. You're right, tech driving higher. The story in Alphabet is one of growth, efficiency and catch-up. The growth, dig into some of the numbers and you understand the cloud division revenue up 35% at just over $11 billion. So that's where the muscle of the growth is. But then you look at the efficiency that's being delivered here, and this is the nuance. They're reducing the AI, the cost of their AI answers by about 90%. 25% of all new code at Google is written by AI. This is efficiency writ large. So you're not going to have any massive headcount adds as we go forward, as you saw a couple of years ago. And they're doubling down on the size of Gemini. That gives you a nice perspective on Alphabet. When it comes to Eli Lilly, guiding lower on the full year. Why? $45.4 to $46 billion. They've had 2 upgrades on their earnings this year. They raised the guidance twice. Why? Killer line here. Wholesalers had higher inventory of Zepbound and Mounjaro, the GLP-1s, the weight loss drugs. You've now got inventory. We've gone from a real stretch of getting a hold of it to inventory. I'll leave you with Reddit. Every company in the world, everybody's customer is on Reddit, that's for sure, up 21.5%. I mean, profit for the first time since they IPO'd. Steve Huffman says this is where you want to be. They're monetizing. How do you monetize the viewers on Reddit? It's with technology. And of course, it's about joining up and offering big data access at Reddit to some of the big AI players. Jonathan.
Manus Cranny, thank you, sir. Appreciate it. 2 hours out there from the opening bell. Equity futures just about positive. Under surveillance this morning, President Biden on the defensive after comments appearing to call Donald Trump supporters garbage. Biden making reference to a comedian who referred to Puerto Rico as an island of garbage during Trump's rally in New York City on Sunday. Biden responding in a tweet that he was calling the rhetoric garbage. I'll tell you what's garbage. To be at this point of the campaign and to be gaslighting the American public about an apostrophe. That is not where you want a campaign to be this morning.
Also having to clean up this garbage of a comment 6 days out from a presidential election when your vice president was making a pitch to the American people that she said she was going to have individuals of all political backgrounds at her table, undermining her message in that moment. Political nails it this morning. Apostrophe, catastrophe.
Although you raised a great question. Why is he even speaking? I mean, this is really the key question. Why is Biden out there in the first place? This is something that he's been increasingly a liability. And I understand that he's the president. And yet this sort of, what's the point of this?
If you were in the Trump campaign, you'd be furious with the individual who booked that comedian, which has overshadowed the whole event. And I think if you're in the Democratic campaign, in the Harris campaign, you're pretty angry that Biden was talking at a time when that speech should have been front and center stage.
And they are. So they sent Governor Shapiro of Pennsylvania out on CNN saying that he does not stand by those comments. Their issue is they're going to have a lot of cleanup to do on this, and it just undermines Kamala Harris. The reason why I think he's doing it, and I have some background information on this, is I think Biden is still quite bitter that he is not the individual running in this campaign.
So he wants to be heard, or he's deliberately railroading the situation, derailing things?
I don't think it's deliberate, but he's gaffe prone. So if you're gaffe prone, you should probably be pretty careful about what you plan to say in the week leading up to a presidential election that you yourself has called a most important election in history, saying it's to, quote unquote, save democracy.
That's the latest on the campaign trail. Promised you some more single names this morning. Here is another one. AMD tumbling after revenue forecasts missed estimates. AMD is looking to catch up with Nvidia in the race for chips, which develop and run AI services. The company also facing supply headwinds after outsourcing production to TSMC. That stock, Lisa, down 8%.
So which is it? And I think it's important. How much is this a supply side issue? I'm glad you mentioned this, with TSMC doing most of the production, as they do for NVIDIA as well. And how much is a lack of demand? They say that the demand is actually very strong. They're making inroads. Lisa Su, the CEO. But a key question here, is this just a matter of not being able to make it quickly enough? Or is this a matter that ultimately the gravitational force is the biggest and the dominant player in this race?
NVIDIA results about a month away. You've got to wait about 3 weeks for them. So stay tuned for that. That stock is down in the pre-market pretty solidly. Elsewhere, Microsoft and Meta reporting earnings after the closing bell. As always, AI expected to be in focus. Investors still waiting to hear exactly how the billions of dollars spent on AI will flow through to sales and to profit. Microsoft getting a lift this morning. Likewise with Meta, no doubt off the back of what we saw from Alphabet.
What we saw from Google was essentially them able to monetize AI in a new way and, frankly, gain clients on their cloud computing services simply because they were able to unroll a whole host of different AI features. So here a question becomes, how much is the AI story going to be increased revenues for the big behemoths, and how much is going to be cost cutting from the fact that those AI tools can really replace a lot of what current humans are doing? And that's what I'm going to be listening to in these earnings calls.
For me, this evening with Meta, I want to know how much they're making off of China advertising. This is a company that cannot operate in China. But ahead of the U.S. election, how much is China trying to advertise on all of these platforms? Last year, 2023, it was 10% of their revenue.
Particularly with the walls set to go up big time if former President Donald Trump gets another term. Let's turn to autos. The EU imposing higher tariffs on Chinese EVs, peaking at 45%. The move likely ratcheting up trade tensions, presenting difficulties for Chinese producers. Major European automakers, including Mercedes and BMW, saying the tariffs will hurt their sales in China. They're already hurting. Bloomberg's Craig Trudell joins us now for more. Craig, just how bad are things right now? I feel like we do a weekly update. How bad are things this morning for the automakers in Europe?
Yeah, you're spot on that they're already hurting. And I think we saw, just the latest, fresh indication of that out of Volkswagen's earnings this morning. They have their worst operating margin since the pandemic, so more than 4 years. And it's to the point where the management have pushed for plant closings in Germany, something that we haven't seen this company do in its history. And so a lot of that has to do with the challenges that this company is having in China. It used to be the case that it could be tolerated that the Volkswagen brand had really weak profitability, because that's okay. Porsche and Audi are doing well, and we're making lots of money in China. That is no longer something that management is happy to tolerate, in part because that is no longer the case. They're no longer making lots of money in China, and Porsche and Audi are struggling in addition to the VW brand in that market.
Craig, you're in Berlin. If Tesla wanted to cut jobs, they'll cut jobs. What happens in Germany if VW wants to cut jobs? How difficult is it to actually do just that?
This is going to be a weeks and much more likely months-long ordeal. I think we're probably headed for walkouts before the end of the year, and it is going to be the case that there's going to be a lot of pressure, not only from the labor side, I think from the German state of Lower Saxony that owns a stake in Volkswagen and also is in control of board seats. There's going to be pressure from that perspective. I think this is very likely a case where management is starting from a position of asking for quite a bit and negotiating back from there. But I do think that it's sort of a testament to just how strong the unions are in this country, that we have been through this for so long, that the VW brand has been so challenged from a profitability perspective, and that factories that have been underutilized for a long time continue on, and whether or not that can last, I think is the question here.
Craig, that's the sort of domestic picture as they look at just how expensive it is to manufacture things and over-manufacture things in Europe. There's a question of what this potential 45% tariff on Chinese autos coming into the Euro region will do for these auto manufacturers. Will that help them in the long run, or will it hurt them by reducing their businesses in China?
I do think there's real valid concerns that these companies are raising, particularly the Germans, in that they're really concerned about only a sort of muted effect from implementing these tariffs on Chinese imports. I do think that there's concern about retaliation here. Particularly, China has warned that they would increase tariffs on large engine vehicles, which would particularly hurt the likes of Porsche and other very high-end brands that, import into China from Europe. And, in terms of, whether or not this is a sort of, Band-Aid here on a flesh wound, I think you look at what, the Chinese manufacturers have planned for localizing production in Europe. They're going to look to get around these tariffs, and that's part of their sort of long-term thinking.
You've been in this industry a long time, Craig. You've been covering the auto manufacturers. We just get a headline that BYD beats Tesla for the quarterly revenue for the first time ever as an EV company. And it raises the question whether the cat's already out of the bag. We're talking about trying to reduce China's dominance in the EV space. But is that already basically a predetermined path? Have they already achieved that? Now it's just whether you merge markets or try to completely isolate.
I think it is still the case that there's plenty to prove for these manufacturers. I would say BYD, even BYD, as much as they've had just remarkable success the last few years, They are trying to move up market, and I think it's really of great concern for the German manufacturers, but also a company like Toyota and their Lexus brand, Hyundai and Genesis. They're basically following that playbook of coming in with more premium vehicles, but at a more palatable price, and putting pressure on the Mercedes and BMWs of the world. And I think that is still something that while there's a lot of interesting indications that those vehicles are competitive, it's going to take time for them to build the sort of brand recognition and value that it took say Lexus decades to build. And so there's still a lot to prove here. I do think that BYD for some time has sold a lot more vehicles in total than Tesla, and on a per vehicle basis, that was the reason why they continued to trail Tesla in terms of revenue. For the most part, they still sell lower end, cheaper vehicles. But I do think that the world is kind of waiting. The automotive world is waiting with bated breath, because we haven't seen indications that this company is really sort of slowing down in any meaningful way.
No, and to your point, they do sell cheaper vehicles. We're talking about under $10,000 for an electric vehicle. Are we going to see price cuts across EVs from, say, Tesla, BMW, Mercedes?
Yeah, I think I think some of these price points definitely grab headlines in terms of some of the entry level vehicles, and you have. You do have some manufacturers in China like Wuling, which is in part General Motors takes part in that venture, that does come in at these really sort of grabby price points of $10,000 or $15,000 equivalent or less. I would caution that some of those vehicles are really small, and so in general I would say that it's not quite as extreme, the price differential between other parts of the world. These are sort of lower speed, maybe not quite as safe vehicles. They would not, they would be unlikely to pass muster in terms of crash test standards. But to your point, I do think that there will be price pressure. We have seen Tesla, after all, just the last few years, really dramatically slash their prices, and I think this is going to be a really intense battle, and one where the Chinese government is more than happy for its companies to grow by way of pricing and not necessarily be too hung up on whether or not its industry is healthy. They want growth, even if it means low to no profitability for companies. They want to take over the world.
Just some amazing headlines in this industry over the last few weeks. Craig, appreciate it, sir. The update there from Berlin. Bloomberg's Craig Trudell on the latest with some of these players. Lisa, I think you're on top of it. Horses and barn doors. The horse is already galloping around Europe, and they're like, oh, better shut the door.
Right.
Come on. How late are they?
And that raises this question, how comprehensive a solution are they going to have to come up with? What do they want their industry to look like? Rather than going piecemeal after what the Chinese are doing, we're seeing them already make those inroads. And the question now is, are you creating the Trojan horse model where they come and build factories in different places in Europe? Or do you come to basically succumbing with your own industry flat on its back and really not in a lot of other places to buy cars from?
Trojan horse with a big sign saying we're here, and they're just like,
yeah, exactly.
Come right in. Not much of a disguise. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Top Israeli officials are weighing a deal to end the country's conflict with Hezbollah in Lebanon. The U.S.-backed proposal would see Hezbollah fighters move away from Lebanon's southern border with Israel. It would bring a 60-day pause in hostilities, with mediators working on a longer-term peace deal. Prime Minister Benjamin Netanyahu met with top aides on Tuesday to discuss the proposal. Hezbollah's position on the deal is unclear. Standard Chartered shares reaching a 9-year high, up 3% in the London trade. The bank reported better than expected earnings from its wealth and trading businesses. Standard Chartered also announced plans to return at least $8 billion to investors in the coming years. The Dodgers leading the Yankees 3-1 in the World Series, and it's Japan's superstar Shohei Ohtani's first appearance in the Fall Classic. And 12% of Japan's population are glued to their screens, but one group is missing out. Traders in Tokyo aren't allowed to watch the games on their mobile phones or TVs. When traders are in the so-called dealing room, they can't have mobile phones on them to prevent leaks, and TVs on the floors are fixed onto finance channels, which leaves them no options for checking in on the game. And that's your brief. John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, markets anticipating Trump 2.0.
We had the best economy in history. We're going to make it much better than even that. We will give our companies the lowest taxes, the lowest energy costs, the lowest regulatory burdens, and free access to the best and biggest market on the planet.
That conversation up next from New York. This is Bloomberg. Equity futures on the S&P 500 fading just a touch. We're just about unchanged. Bond yields are lower. We're down by 2 basis points. The 10-year 423.22. Under surveillance this morning, markets anticipating Trump 2.0.
We had the best economy in history. We're going to make it much better than even that. We're going to bring all these companies that left us because of stupid politicians on our side. They allowed it to happen. They're all coming back, either that or they're going to have to pay tariffs like they never had to even think about before. I will cut your energy prices in half within 12 months. And to bring back millions of jobs, we will give our companies the lowest taxes, the lowest energy costs, the lowest regulatory burdens, and free access to the best and biggest market on the planet.
So here's the latest this morning. The former president proposing a number of economic initiatives under the new American industrialism plan, including a 20% tariff on all imports, 60% duty on Chinese goods, and a tax on U.S. companies that send jobs overseas. The former deputy assistant for the president for international economics, Clete Willems, joins us now. Clete, welcome to the program, sir. I want to start with process and priorities, and I want to lean on your experience in Trump 1.0. You got on board just as they were kicking off the trade war. Can you walk us through how they'll be thinking about where the emphasis will be on which side of the policy agenda if they get another shot at this?
Sure. Well, obviously, as you're hearing from the remarks from President Trump, trade is going to be a day one top tier priority, and I expect that he'll get into it pretty quickly. Now, I think from a process standpoint, it's important for folks to realize there's a couple things he can do almost immediately, very quickly, and then there's some other policies that he's probably going to want to talk with the team a bit, as well as consult with other policymakers like Congress in Washington. And so on that first list, the things that I could think he can come out of the gates very quickly on is China. And we already have an existing mechanism under Section 301 where we've got hundreds of billions of tariffs in place on China. And he can move those up, down, and around in order to try to force China to comply with the Phase 1 deal or to address unfair trade practices. So that can happen quickly. I think on digital services taxes, the U.S. started investigations into 10 different countries. You know, France is probably the most prominent, a country who has been unilaterally taxing U.S. Digital companies. And there was an existing mechanism on that that he could turn on probably pretty quickly, maybe within 60 days, and start tariffing their products if they don't comply. I think some of the things that we're going to have a little bit of a longer time frame, a little bit of a longer fuse, are these across the board measures as the president works with his team and figures out exactly how he wants to implement that. I think he's going to take a very serious look at it, and the process will start very soon, but that implementation may take a little while as they figure out the finer points.
Howard Lutnick was on recently, and he said tariffs would raise $500 billion. He's leading up the Trump transition team. Where does he get that $500 billion from?
Yeah, I don't know exactly where that figure is, but if you look at the China tariffs that we've already had in place, you know, they've already collected hundreds of billions of dollars. And if you put that over the 10-year horizon, which is what everyone's talking about in order to pay for the tax cuts, you could get a figure close to that. And one of the things I'm hearing from friends in Congress is that they are taking very seriously this idea from President Trump about using some of the tariff revenue to help pay for the extension of those tax cuts. And so I really do think you could see those two things coming together next year.
But how much are the tariffs going to cost the United States if it's a tit-for-tat scenario like we had in the prior administration, Trump 1.0, and there was billions of dollars given to farmers because China was no longer accepting their goods?
So look, I think you need to look at these tariffs as part of the holistic economic policy. right? I mean, tariffs are one part of the equation that's going to fit together with tax cuts, with deregulation, with efforts to lower energy. So I think it's dangerous to just say in isolation, this is the impact of a single tariff on the U.S. economy. It's part of a much bigger picture. Now, in terms of your question about retaliation and how all that's going to work, I think it's really going to depend on how other countries respond. And ultimately, the U.S. is going to make the case to other countries that, look, your measures, by and large, your tariff rates, by and large, they're higher than ours. You are doing a lot of things to keep out U.S. products from your markets. You know, the president likes to focus on the EU, and the reality is we have a massive trade deficit with the EU on agricultural products because they don't buy our beef, they don't buy our pork, they don't buy our chicken, and they give lots of excuses for why that's the case. But the question is going to be when President Trump says, okay, if you've got barriers on our products, we're going to put barriers on your products. The question is, how do they respond? And I don't think we can sit here and predict that today. But those are the kinds of questions he's going to try to force.
But Clete, you don't honestly think there's not going to be retaliation? I mean, we already saw retaliation the first time.
I do expect that countries will respond. But ultimately, what I would say to them in return is, look, you know, we have an average tariff rate of 3%. If you go to Europe, it's about 5%. If you go to China, it's higher than that. If you go to India, it's 18%. And so I think the appropriate response to the United States is to say, hey, we're gonna meet you, and we're gonna both try to have equivalent and fair trade measures. And that's what the president's gonna try to achieve.
Clete, just quickly here, there's a belief in a lot of business executive areas where they believe that this president, that former President Donald Trump, will respond if the stock market sells off in response to one of his proposals. That if he does propose really big tariffs and the S&P tanks, he'll say, just kidding, I'm going to pull that back. Is that true?
Well, I don't know about the just kidding part, but as I mentioned before, I think you really need to look at these things holistically and think about how they fit together. And when you've got all these other things going on taxes and regulation, I mean, that's going to be part of the equation. And on the trade front, I don't want to put this in terms of sort of what the market does on one day or another, but the objective here is obviously to try to promote more manufacturing in the United States, to try to get fairer terms of trade abroad. And I think if the president can successfully execute on that, I mean, that's going to be good for the market. That's going to be good for our economy. If there's less barriers to our exports, there's less Chinese subsidies distorting our markets. So again, I can't say on a day-to-day basis how the market will fluctuate, but there is a longer-term strategy here that needs to be looked at holistically.
Many a thesis has been written about the regulatory hurdle in Europe around food and whether that's stealth protectionism or not. And we can have that argument and debate another time. Clete Willems of Akin. Clete knows that. It's good to see you, sir. Thank you. Big takeaway there. Trump 1.0, taxes first, trade later. This time, you could see both at the same time. And as you know, Washington, D.C. better than most, that's going to be very complex and quite hard.
It is. And tariffs, he can do unilaterally day one. Taxes is going to be a negotiation in Congress. And we need to know the composition of Congress, whether or not we could see how much taxes they can cut.
And potentially a very long negotiation. In the third hour of Bloomberg Surveillance, Emily Roland of John Hancock, Anurag Rana of Bloomberg Intelligence, Claudia Sahm of New Century Advisors, and Michael Kushma of Morgan Stanley from New York City. This is Bloomberg.
Just a significant amount of uncertainty in the risk-free asset class.
I do think the bond market is being used by people to protect portfolios.
The potential for an inflation boomerang next year is actually rising.
This idea that we're getting a soft landing has almost transitioned to the idea that we're getting maybe no landing.
There's still room for the Fed to implement a few rate cuts from here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell. Here's the state of play for you. Equity futures on the S&P 500 pairing gains over the last few hours, just about unchanged, even with a big lift for Alphabet after the close and through this morning, following some pretty decent earnings from them. On the Nasdaq 100, we're positive by 0.1%. On a Russell, the small caps down by about a third. On the earnings front, Alphabet yesterday, later on today, Microsoft and Meta tomorrow, Amazon and Apple. On the data front, a little bit later this morning, in 30 minutes' time, get another read of GDP for you. Then on to tomorrow, you'll get jobless claims. Then the big one on Friday, the payrolls report. The estimates are still coming in into our survey. Just to give you another sneak peek of things, 110 is the median. 110 is the median. 254 is the previous number. And the range of estimates still really, really wide. on Wall Street.
As is the range of ideas about how relevant this is going to be to the Fed or anyone else, given how messy it is due to the hurricanes and the strikes. We also get ADP in about 14 minutes' time, and I'm very curious to see whether that shows the same kind of confusion that we saw in the JOLTS data at a time where it really raises a question, is the Fed on autopilot to cut 25 basis points truly twice more this year?
JOLTS data, consumer confidence, really confusing. When you look at jobs plentiful, jobs hard to get, they're telling very different stories. Andrew Hollenhorst of Citi just publishing saying we expect 90K payrolls growth with downside risk and unemployment rate rising. If the unemployment rate rises for what they say 4.23%, or if unemployment rises regardless, that is something the Fed can easily lean into 48 hours after a presidential election where they may not know the result.
What's really strange about the consumer confidence numbers is this is meant to be the hurricane disruption numbers. These numbers are meant to be distorted, noisy, and they're strong. Which begs the question, if we get a strong print on Friday, how does the Federal Reserve respond to that at its meeting next week?
If they cut, you end up with a situation where the Fed cutting rates leads to a tightening in financial conditions. And this is something I've been thinking a lot about, because if you take a look at the rise in the long end, that could continue if they cut rates at a time when you are seeing ongoing strength in the labor market. And commentary like this from the Royal Caribbean CEO: we do not in any way see anything in the ingredients that say we are hitting some type of ceiling. If anything, we see continued acceleration in demand for our business, for taking cruises, for the travel and leisure sector. That's the reason why I think this is actually a really interesting moment with how the Fed responds.
For as long as people on Bloomberg Surveillance refuse to go on a cruise, we have not hit the ceiling just yet. Still not going on a cruise. It's not happening. In the bond market, yields lower by 2 basis points on a 10-year 4.23 after breaching 4.30 briefly so far this week. Coming up this hour, Emily Roland of John Hancock as the Nasdaq hits a new record high. Claudia Sahm of New Century Advisors looking ahead to payrolls, and Michael Kushma of Morgan Stanley with treasuries on track for their worst month in 2 years. We begin this hour with stocks pushing just a little bit higher on the Nasdaq. Investors digesting big tech earnings and looking ahead to more economic data. Emily Roland of John Hancock staying cautious, saying we are not making big bets and would rather wait for some value in riskier markets. Right now, we would push against this reflation impulse in markets by putting cash to work in bonds. Emily joins us now for more. Emily, good morning. It's good to see you.
Good morning. You too.
Let's talk about some of these weird inconsistencies in this market, shall we? You've identified a few. Bond yields are up, oil backed away. There's one. Gold prices have rallied all year. The dollar's still strong.
Yeah.
What gives? How do you make sense of all this?
It all comes down to the election, and we're kind of process of elimination investors. When we look at this backup in bond yields, we want to say, well, is it commodity driven? Are we seeing inflation expectations increase? And in fact, there's a lot of signs of disinflation right now. We look at things like wage growth. That's gone from as high as 4% on average hourly earnings down to 2%. Initial claims still contain, continuing claims actually quite elevated. The quit rates come down. So the days, by the way, of leaving your job and finding another one to make more money, I think are behind us at this point. Another undercovered story, I think, is housing inventory. So inventories are up 23% year over year. We think that that shows continued disinflation in housing. Remember, shelter's been responsible for 60 to 70% of the gains in core CPI. So that is another element. And then commodity prices, I think with WTI now hovering around $70, that's not that bad. If you want to see another 1970s style increase in inflation, you've got to see that accompanied by a rise in oil prices, and we're just not seeing it.
Ian Lingen, BMO. We're sympathetic to investors' reluctance to challenge the prevailing trend. Do you want to step in front of this before next week?
We do, because I think there's an opportunity to lean into areas of the market that are mispriced. Look, there's some things we don't know, like who's going to win the election, and there's things that we do know. We do know that right now, bonds are one standard deviation cheap to their 20-year average, with the aggregate bond index yielding 4.7%. We know that stocks are expensive, 22 times forward earnings. I think that's being supported. I wanted to tie together what you were talking about with consumer confidence. If you look under the hood, the biggest categories that saw positive responses was, do you think the stock market's going to be higher a year from now? And are you planning to take a vacation to Europe? I mean, we're starting to lose one of the assets that this market has had, which is a lack of bullish sentiment. So we think about markets being priced for perfection, and bonds, they aren't.
Well, they might not be priced to perfection, but they do reflect something that does seem related to the Fed meeting, because 2 days before that September Fed meeting, we saw the cycle low, or at least the low in the past few months. And then it was just a straight moonshot for yields higher on the long end. Do you buy the idea that in some way The Fed's 50 basis point rate cut actually tightened financial conditions because people are saying, okay, they're going to cut rates and they're going to keep rates at a higher level going forward, a higher neutral level, just because this is an economy with much more potential.
Yeah, it absolutely did. And I think the biggest transmission mechanism you're seeing through that is through the stronger dollar. The dollar strengthened rapidly. I think there is a political sentiment element to that move as well. But you've seen that tightening financial conditions. Now, the big question is, does the Fed actually need to continue to cut rates, especially if we see more fiscal spending? So that's been one of the biggest narratives and the biggest drivers of this move in bond markets. Maybe they don't, but because the political backdrop remains so uncertain, I think it's hard to really handicap what the Fed is going to do next at this point.
But if the Fed cuts by another 25 basis points next week, do you end up getting less bullish on duration because of this idea that in some ways they're going to allow growth to be a lot more robust for longer?
Yeah, not necessarily, because there's another component to the total return potential in bonds. The duration part, yes, you might have to wait to get paid on duration, but I'm okay waiting. We've talked before about sort of bonds and chill. And I think that's appropriate for this because the income's so elevated. You're looking, again, at a combination of high-quality bonds. I'm talking about mortgage-backed securities, treasury bonds, investment-grade corporate bonds, like single A. Nothing wild here. And that's going to get you income close to 5%. I'm comfortable getting paid to wait because even if bond yields rise modestly, maybe there is a little bit of a growth impulse after the Fed cuts again. Eventually we see bond yields falling and we're willing to be patient.
You're concerned about the election, the risk leading up into it, and potentially investors want to wait on the sidelines. Yeah. Is it because they want clarity, or do they need to know the composition of who's going to be in Congress and who's going to be in the White House?
I think it's both. I mean, certainly markets love clarity, and you've seen the statistics around markets tend to rally once the outcome of the election is known, and I think that's something that investors certainly want, although they're not acting like it. We're seeing massive risk-taking going on right now, things like cryptocurrency, and you guys have talked a lot about DJT and other sort of riskier, unprofitable corners of the market seeing this bid. And again, investors are becoming a lot more optimistic here, and I think we want to be back to the chill kind of part of this story. Like, why don't you have a portfolio? Maybe I'm thinking about this because there's a lot of states that are trying to legalize marijuana. I'm not really sure, but maybe you want a portfolio of high quality stocks. Maybe you want a portfolio of high quality bonds that can help us really navigate this really tricky environment that we're going to be in for the next couple of
years. If Trump does win, is there more to be priced in?
I think a lot of it's already happened. That's the thing. So we looked back at the market action post 2016, and what we found was that because we didn't know that that was the outcome, a lot of the move happened after the election. Small caps is one example. They were up about 30% in 6 weeks after the 2016 election. Bond yields moved meaningfully higher, but because the markets are really betting on the betting odds right now, we're seeing a lot of these moves already in the price. So there may be a buy the rumor, sell the news element here once we know that what the outcome is.
So could you just give us a sense of what chill looks like for you right now? Is it basically just go to work, buy some 10 years, sit back, go out to lunch? Is that basically what we're talking about here?
That sounds nice. We are considering legalizing psychedelics in Massachusetts, actually. So
right.
That could be another. No, I'm kidding. No, really, it's about
Senator Warren initiative.
No. Well, we can talk about that maybe on another show. But what we're looking at right now is, and I think this earnings season's reflecting what's been working in portfolios and where we've been overweight. It's companies with great return on equity, tons of cash, great balance sheets, a better ability to maintain margins. So we've been overweight U.S., we've been overweight U.S. quality and mega cap tech. That's where the earnings are coming from. Stock prices follow profits. That's where we're looking at in portfolios. And then again, getting out of riskier areas in the credit space, moving into high quality bonds. I think that's your narrative for the next, stretch of time.
When you speak to the pollsters, it's amazing. They'll tell you this race is still really close and market participants are looking at the same market. It just feels like a classic example, and we cover this kind of thing all the time on this program. Price setting narrative. Yeah. That's what it feels like in financial markets. It feels like the price is setting the narrative around the election. Then when you speak to the people who are basically employed to follow the said election, they'll tell you it's still really close.
And then there are questions around whether there are people manipulating the price to try to set the narrative and then have that turn into some sort of cyclical prophecy. But that's the reason why people are pushing back now.
And we've also seen that before in the past cycles when it comes to the betting markets. There was a Romney whale. Romney lost. He never saw the West Wing. So you have to take all of this with a grain of salt.
And just quickly, not sure and yes. Not sure about stocks, but yes, Europe and vacations. Emily, thank you. Emily Roland of John Hancock. Had to squeeze that in. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. BYD notching a win against Tesla. The Chinese automaker reporting revenue quarterly that beat Elon Musk's company for the first time since the pair have gone head-to-head in global EV sales. BYD revenue actually fell short of estimates, but it still beat Tesla in the period ending September 30th. BYD has been more insulated than Tesla as demand for EVs have waned. Boeing and striking workers resumed talks yesterday in an effort to end the 7-week-old strike. In an update on social media, the union said it had a productive face-to-face meeting with the company to address key bargaining issues. The strike is taking a toll, though, on Boeing. Instead of generating cash in the fourth quarter, the company now expects to burn through around $4 billion. 26 North founder and multi-sports team owner Josh Harris joined David Rubenstein for an interview marking the 10th anniversary of peer-to-peer conversations. They discussed the future of public and private markets, alternative assets, and how he's preparing for the U.S. presidential election.
If you have a candidate that is more regulatory-oriented, that might affect certain industries like energy or healthcare differently. The antitrust policy could be different. That could affect acquisitions. So you have to think about all that and just be prepared for it. I think that if there's no clear outcome, could create some volatility. That may be a buying opportunity.
To see more of that interview with Josh Harris, tune in to the David Rubenstein Show, Peer-to-Peer Conversations, tonight at 9 p.m. Eastern, right here on Bloomberg TV. And that's your brief, John.
Danny, thank you. Up next on the program, the Morning Calls Plus, we'll get you some ADP data. That's all coming up next on the program. Just to mix things up, an ADP report for you. Here's Mike McKee. Good morning, Mike.
Good morning. 233,000, which is a significantly higher number than was anticipated. The forecast was for 111,000. The September number revised up to 159 from 143. Remember, we had a major increase in jobs in the month of August and September, where we saw jobs rise by 223,000 in private payrolls. That's the comparable to the ADP. So this is a number that does suggest some real strength in the labor market that maybe hasn't been expected.
First question, what happened to the hurricane noise that everyone's pricing in for Friday?
Well, here's the thing about the hurricanes that we don't know is the timing effect, because the hurricanes hit on sort of either end of the reference week, which is the week that includes the 12th of the month. And so if you worked at all, if you worked an hour, then you would be counted as employed. And so it is very possible that the people from Helene got back to work, a number of them, and the people from Milton hadn't yet lost their jobs in the meantime. So that's something we're going to have to keep an eye on Friday when we get the numbers. And usually the Bureau of Labor Statistics puts out a little note that says how much they think the hurricanes impacted the jobs report.
So this is above all estimates by Bloomberg. This is the highest level for ADP going back to July of 2023. And we're looking at a time where people are wondering what the overlap between ADP and the labor market report that we get on Friday is. A lot of people say it's not very much. And then what kind of tell factor this is going forward. What's your read, especially with the new methodology for ADP, in terms of how significant it is for broad macro data released by the U.S. government?
Well, what ADP has done is backed off the idea of trying to predict what the labor market report is going to be and just sets this up as a separate data series that in many ways is similar, constructed in a similar way to BLS. It just uses ADP's payroll numbers instead of the surveys that the government does. And so it tracks. It's much better what we end up getting, but it doesn't give you an exact number. You can't say because this was 233, we're going to get a very high number, but it does suggest that we may get a higher number than is anticipated, which is at the moment 110,000.
unlocked some higher yields at the front end of the curve. We're up by 3 basis points on a 2-year at 412.50, unwinding some of the rally that we saw further out along the curve. The 10-year had yields lower by 3 to 4 basis points earlier this morning. Yields now just a little bit higher on the session. If we're looking at the economist estimates, we were looking for 111. We got 233. And if you're looking for the estimates on Friday, this is precisely why the range of estimates is so wide. Wide by about 190k, 180 at the high end from Mizuho. Lisa, negative 10 at the low end for Friday from Bloomberg Economics.
You asked earlier, what would the read-through be to markets if it was an upside surprise? And that, I think, is an increasing possibility that we have to think about with this ADP report that is not predictive, but does indicate that strength that we also saw, depending on what you wanted to look in yesterday's data, considering it was all over the map.
You mentioned the hurricanes. We also have the Boeing strike, and ADP finds 19,000 manufacturing jobs off the payroll, which could be related to that, and 37,000 additional construction jobs, which could be related to Hurricane Helene.
Mike McKee on the random number generator this Friday. We're all looking forward to this, aren't we? This one's going to be noisy. Equity futures on the S&P 500 just about unchanged. Let's get you some morning calls. Just the one stock in focus now, Alphabet. First up, Morgan Stanley raising its price target to 205. The analyst highlighting the impacts of Gen AI. That stock is up by close to 7%. Your second call from Barclays lifting its price target on the tech giant to 220. The analyst saying that while the AI story is progressing, shares could remain choppy. And finally, Baird lifting its Alphabet price target to 205. The analyst noting that AI resources can boost further market share in advertising. Let's stick with tech. More results coming after the closing bell, including from Microsoft. Joining us now to discuss is Anurag Rana of Bloomberg Intelligence. Anurag, we've heard from the likes of Alphabet. What do you think the read-through is, if any, for the likes of Microsoft a little bit later?
Yeah, for both Microsoft and Amazon Web Services, we think the bar is high now. They really need to beat by a big number to show that they are also getting the benefit of Gen AI workloads.
Some of the improvement to productivity that we've seen already has been absolutely staggering. This came from Alphabet's numbers yesterday, that new computer code is written by AI, more than a quarter of it. More than a quarter, Anurag. Are we already seeing some big changes, not outside of these companies, but inside of these companies?
Yeah, we have been saying this for a while, that when you look at Gen AI use cases, the biggest one in our view is code generation by some of these co-pilots. We recently had Amazon Web Services on one of our podcasts, and they talked about a massive shift in productivity on their back end as well.
At this point, Anurag, how much of a tell is Google for Meta, for the likes of Microsoft?
I think when you really think about it, when it comes to the benefits of Gen AI, cloud providers, I think, are one of the biggest ways to look at this stuff, because there are companies that cannot run these Gen AI workloads internally, which is they don't have the capital to go out and buy GPUs, AI servers, then hire people and do this internally. It's much easier to go to a cloud provider and just outsource it there.
At a certain point, Anurag, then, are you saying that Google's gain is also a gain for Microsoft and will also be a gain for AWS of Amazon? Or are you saying that it's really who can be the best at AI to really attract that type of a clientele?
Yeah, our thesis is that when you look at this space, I think the entire space balloons up or expands in market. So any of the top 4 vendors, and I would include Oracle in that too, would be beneficiaries of this shift as more and more people move their workloads from on-premise to the cloud.
What's going to happen with hiring, Anurag? I really want to understand that. Can we just spend some time on that? How many people are these guys going to hire in years to come? How much of a problem will youth unemployment be in years to come because of the productivity initiatives they're developing and pushing across the companies across Silicon Valley and beyond?
Yeah, that is, you're absolutely right. There's one of my biggest issues right now is I'm not seeing the same level of hiring that comes with the revenue growth rate. If you go back a few years, and again, I'm talking even before pre-pandemic time period, there was a large correlation between revenue growth rate and headcount growth rate. But for the last, I would say, 1 year or so, I'm not seeing that. And that's a bit concerning for me. not just for unemployment or employment, but also for application software companies that really sell their software to not just technology companies, but other companies as well, the likes of Salesforce and Workday that are priced on a per seat basis.
This, Lisa, is going to be an issue for society. It is a society issue, a societal issue right now, I think, and not just for this industry. You're going to see this on Wall Street too. And this goes back to a conversation we had with Brian Moynihan of Bank of America at the start of the year. This is going to help you grow revenue. How labour intensive would that revenue actually be? And basically the pushback we got was pretty clear. We're not going to have to hire the same amount of people to generate the same dollar revenue improvement, incremental improvement that we're going to see potentially over the next few years.
Yeah, Brian Moynihan is saying that his staff will be the same size, even as the business continues to grow. A real question here about what kinds of jobs are going to be necessary. Jamie Dimon was talking about how he doesn't know exactly what that will look like for JPMorgan, but he does know that the mix of jobs is going to change, and he's already seeing that now.
Anurag, great to catch up, sir. Appreciate your time. Anurag Rana there of Bloomberg Intelligence on the latest for Microsoft. On the jobs front, no problem with jobs right now, according to ADP. 233, the number, the estimate 111. Looking ahead to payrolls Friday, we're looking for 110. I just wonder how many people sort of bumped their number up after hearing from ADP this morning.
ADP used to be dismissed as not predictive, as Mike was saying, of the non-farm payrolls report, and so people wouldn't pay attention to it. Now, increasingly, it has taken on more import as it actually tracks better once you look at the revisions than it has in the past. A real question here about whether we continue to underestimate the strength of the U.S. economy at a time of ongoing muddiness in a lot of the data.
Mike McKee, you've got a final word on the data you just saw.
Yeah, we did find a little bit of a hurricane effect in east-south central part of the United States, a loss of 13,000 jobs. So that's probably hurricane related. But we did lose 6,000 jobs in New England. And I'm not sure what that's about. The weather was really nice in September.
How did you process the data from yesterday, the contradictions that we saw? For jolts to be that poor at a time when the payrolls number that month was so good?
Well, I think that it's a reflection of it. I mean, if more people get hired, there are going to be fewer job openings. So, they don't match up exactly.
You don't think that's a reflection of cyclical weakness then, the numbers we saw yesterday?
It's too early to say with just one number. What was really interesting is consumer sentiment. Why is that rising? It's maybe due to the election and the fact that maybe everybody's happy it's almost over.
Well, I'm sure that a lot of people would be sympathetic with that, but you have to wonder, which is more accurate, the JOLTS data or the consumer sentiment survey that's been a whipsawing? I mean, this is a far cry from what we saw the last read.
Well, I would focus on the consumer sentiment number, jobs diffusion, jobs hard to get versus jobs easy to get, and the jobs easy to get went way up. The diffusion widened and jobs hard to get went down. And that's always been a pretty good indicator, whereas JOLTS now only has about a 20% response rate, so it's not considered perhaps as accurate as it used to be.
Mike McKee, stick around. We've got some breaking GDP data in just a moment and the latest numbers from the Treasury. Claudia Sahm of New Century Advisors and Michael Kushma of Morgan Stanley here to react from New York. This is Bloomberg. So moments ago, about 15 minutes ago, we had a big upside surprise on the ADP employment change report. That came in at 233. The estimate was 111. In just a moment, we'll get you some GDP data and the latest numbers from the Treasury refunding announcement. So here are the scores going into that. Equity futures on the S&P 500 shaping up as follows, just about unchanged. Likewise on the Nasdaq. As for the Russell, we're a little bit softer by 0.25%. In the bond market, following that data this morning, yields up at the front end by 3 basis points at about 4.13. On a 10-year, just about unchanged on the session now at about 4.25. With some economic data, let's cross over to Mike McKee. Hey, Mike.
Well, we've got the GDP numbers out. 2.8% for the third quarter is the initial estimate. That's just a touch below 2.9%, which was forecast. And one of the things that happened, of course, we had a 3.1% forecast from the Atlanta Fed. And the problem is then we had that big trade report yesterday as everybody tried to bring in inventory ahead of the port strike. And so that is probably subtracting from growth. We'll get that number for you in a moment. Personal consumption, though, very very strong, 3.7%. That's up from 2.8% in the second quarter. Americans are still spending money. The GDP price indexes, which are quarter over quarter, so not as important to the Fed as the one we'll get tomorrow, 1.8% for the GDP headline index. That's down from 2.5%. We're in the ones now there. And core PCE on a quarter over quarter basis, 2.2%, down from 2.8%. Now, the one other number, the information we want to give you is the quarterly refunding from the Treasury Department. This one has very little change in it. It isn't going to be very exciting to the folks on Wall Street who pretty much called this. $125 billion is going to be offered, refunding $116.4 billion, $8.6 billion in new cash. Bill auction sizes stay the same through November. There'll be modest reductions in December and then increase in January. Treasury does not anticipate increasing auction sizes the next few quarters. And what we have for refunding is 3-year notes, $58 billion, 10 years, $42, and the 30-year bond, $25 billion. And we got the kind of standard warning ahead from the Treasury Borrowing Advisory Committee that the debt limit, which we will hit at the beginning of next year and has to be passed again, it could screw everything up in the Treasury.
We might be turning the volume up on those issues over the next 12 months as well. So Americans are consuming and investors are selling bonds. Yields are up by close to 5 basis points at the front end, almost at 4.15. Let's call it 4.14 right now. On a 10-year, we unlock high yields there as well, up by a basis point or two to 4.27. We had breached 4.30. We backed away in yesterday's session. We had seen a 6-day run of high yields at the front end. We snapped that yesterday, but it resumes this morning off the back of an upside surprise on ADP about 17 minutes ago. And Lisa, a pretty punchy personal consumption number just moments ago.
Yeah, the 1-2 punch of ADP coming out double the expectation, more than double the expectation, and 3.7% personal consumption just goes to this feeling, are we not seeing the strength in the U.S. economy that keeps surprising to the upside? That economic surprise index, that's what I was pulling up right now. We could see it continuing to climb to the highest level going back certainly to earlier this year, going back to April of this year. So it raises this question, are we also underestimating what we could potentially be getting on Friday or, amid the noise, also what we get tomorrow with core PCE, because the core PCE also came in just slightly higher?
So this is why it's so difficult to try and understand, trying to unpack what is driving bonds here. The data, just a series of upside surprises, to your point, Citi going all the way back to April, or the politics. And the reason matters, and this was really the essence of Mohammed's piece yesterday on Bloomberg Opinion. He said the following: while most analysts agree on the list of potential contributors to this unusual development, there is little consensus on their relative importance. This matters for what we forecast about the future well-being of the economy and the sustainability of this year's impressive stock market performance. Are yields higher for good reasons, everything we just discussed over the last 15 minutes, or for bad reasons, worries about deficits and big sweeps leading to more debt?
And until we have clarity on that, do we just see the two markets trading to their own music? And that's essentially the question that Jack Caffrey was trying to unpack. And a real question here about higher yields in and of themselves can't torpedo stock market valuations if people can ignore the potentially bad reasons that they could be potentially rising.
Well, with ADP and GDP, we've got reason for people to bet on the strength of the economy. Although the headline number was a little lower than anticipated, personal consumption, as we mentioned, is very high. But business investment is also strong, 3.3%. That's down from 3.9%, but it is still relatively strong for non-residential private investment. Structure's down 4%, and that was forecast because we had a lot of structure building, factory building. Now people are buying this stuff to put in those factories, with equipment purchases up 11.1%. The real difference here is in what we saw in trade. Imports were up by 11.6% of goods. What's interesting is they don't really show up in inventory, so we're not sure where they are at the moment. Inventory is 60.2 billion, and that should mean strength in the fourth quarter. Government spending was up 5%. National defense, a large part of that, up 14.9%. We're sending a lot of stuff to Israel and to Ukraine, so we're buying a lot of stuff like that. But then the final line you'd look at is final sales to domestic purchasers, gets rid of the inventory and trade numbers in there, and we're up 3.5%. Which is the strongest since last year.
Bond yields off the back of all of that, up 5 basis points. At the front end, the 2-year, 4:15. Joining us now to discuss is Claudia Sahm of New Century Advisors, a good friend of this program. Claudia, welcome back to the show. Let's get into this economic data. How would you characterize the economy in America?
Good news is good news. I mean, this is excellent on the GDP, particularly when you look at the consumer spending. It's not just one quarter. We have now put together 4 quarters that are about 3% growth in consumer spending, inflation adjusted. And as Michael said, you put that together with business investment, right? Like, that's what we're looking for. Like, this is a really good report, and it's not one to be afraid of. The Fed is not going to be afraid of this report. We have supply coming online. We have productivity higher. Like, this really is good news.
Claudia, they might not be afraid of the report, but they could be potentially a little concerned about the response to the report in markets. At what point does it get the Fed's attention that longer-term yields keep climbing on the back of an ongoing string of better-than-expected economic data?
The Fed is going to be paying attention to what markets do, regardless of whether it's what they're expecting or what they're not expecting. It's hard to play three-dimensional chess with markets. There are a lot of factors that move markets. The Fed is an important player in the mix, but it's not the only. But it absolutely will be looking at interest rate sensitive sectors, places where it could go in. And if there needed to be some support, cut rates, get some support. But that's not what we're seeing right now. We're seeing a very strong economy. And what the Fed has to look for are any signs of it overheating. Right? Is that consumer spending? Is that demand that's really outstripping supply? And at this point, we really do not see signs of it. And we haven't for several quarters, right? Like this, we are in a trend place that is much better than, frankly, we went into the pandemic with.
There are 2 different arguments here. One is this question of whether we're overheating and thus causing the Fed to stop cutting rates. And the other question is, are we underestimating the neutral rate that we could potentially be looking at in an economy that keeps chugging along, even with rates that the current Fed says are significantly restrictive? So which is it, Claudia? Because there are very different responses on the Fed side to either of those 2 potential outcomes.
At the end of the day, we want the neutral rate as high as absolutely possible, because a high neutral rate is a sign of a healthy economy. The low interest rate economy that we went into the pandemic with, that was not a healthy economy. It created a lot of distortions, but it also was just a sign. Interest rates are a price. They are telling us something about the economy. And if it turns out that this economy comes out with higher productivity growth, higher underlying trend, well, we would expect that to show up with a higher interest rate, and it's an interest rate that we would tolerate. Like, it wouldn't be restrictive. It'd just be we have a stronger economy. Now, it is too soon to say that is what we have moved into. This still could be, working through some of the temporary disruptions of the pandemic, and we could go back to a lower trend growth. And I think Europe is very much a cautionary tale, right? They are not having this conversation of, have we gotten to this higher trend level? Is our star just so much higher? So there's still a lot in the mix, but again, where our star lands, I mean, that a high R star is perfectly fine, but we are in that process of discovery of is this good news going to stick with us?
Well, when you say good news is good news, does it marginally increase your best guess about where the neutral rate is? Do you think that it's more likely around 4 now than 3.5 as the Fed's projecting?
I don't know if I go quite as high as 4. I think, into the solid 3% is what this looks like. And particularly, again, if the implicit productivity growth that goes with this GDP number and a labor market that, while still solid, has slowed down quite a bit, right? So we're getting a lot out of the resources that we're putting into the economy. And so if that continues, then yes, I think something in the mid 3%, probably maybe even higher, would make sense. But that's where I think the Fed, they have their first 100 basis points, the next 100 basis points, I think are pretty safe in the, that's still restrictive, we can chip away at that. And then you do get into a conversation as you get past that of, okay, is this where the economy wants to rest?
Claudia,
and,
if we're going to live at higher interest rates, what does that mean for the housing market?
Again, a higher interest rate environment, when it's behind it is productivity growth, you also have higher income growth, right? And so interest rates are a price, just like house prices are another price that people face. And what at the end of the day matters is the affordability, right? Do you have the resources to afford those homes? Now, of course, the higher interest rates do run into the fact that we have had a housing underbuild for quite some time. And so if you think that, if we're going to try and fix that underbuild just with market prices, so the adjustments of the interest rates, that one is going to be tricky. But I think there are certainly policy proposals on the table at various levels of government to try and work on housing supply and not think of it purely through interest rate mechanisms and what the Fed might be doing.
Right, but that could take years to come to fruition. So if you're sitting on a 3% mortgage and rates you say are going to be higher for longer, what impetus is there for those individuals to give that up?
There's not. I mean, that's what, there are always, if there are big shifts in the economy, there are going to be winners and losers in terms of where they sat on like the bet, right? On the information when everything changed. So, that's just a reality of how the economy works. It does mean the housing market went into the pandemic in a place of disruption because of the housing underbuild. And then it has been throughout this entire period in different forms of disruption, whether it was really fast-paced demand, really low interest rates, whether it was no inventory of housing. So that is a extremely disrupted sector, not just because of interest rates. And I agree with you. There's no magic wand in that market. It's going to take time. And it's an extremely important one to get right-sized.
One thing I know for sure is that was personal to Anne-Marie, Claudia. She just wants to buy a house. That's all it's about. Is that what that was about?
It feels like the boomers, or those that time the market correctly, Lisa,
I know.
are the
Okay.
winners, and then those that are younger trying to get in the housing market are the absolute losers.
Are we calling Bram a boomer?
No, I said those that, I know, I called her a winner for timing the market correctly.
I'm not sure Bram.
I bought in April of 2020, so I wasn't going to rub it in, but yes. And
Why
I'm
not?
a boomer.
Why not?
Go
And since
for
we're
it.
being personal here, Claudia, can I just have one personal note, just quickly? We know you're in your own personal battle right now. And I just want to say on the behalf of all of us, and if I may, the whole financial community as well, because I've had a ton of messages just before you appeared with us. We're all thinking of you. We're all thinking of you, and we appreciate your time. We're lucky to have you this morning. Thank you so much for being with us. Claudia Sahm there of New Century Advisors. Got some data a little bit earlier this morning. If you are just tuning in, welcome to the programme. About 30 minutes ago, had an ADP report coming in with a pretty strong upside surprise. Mike McKee was breaking down GDP, and within that GDP number, personal consumption really strong as well. So at the front end of the bond market, bonds down, yields up just a touch. Michael Kushma of Morgan Stanley Investment Management joined us now for more. Michael, good morning.
Morning.
Seen a big move higher in yields over the last month. Do you want to step in front of this before we resolve the issues we have on the table next week?
It's challenging. It's challenging because they've been rising for all sorts of reasons. Data has been surprisingly strong. The market was long going into the September FOMC meeting, and given the information that the FOMC and Powell were providing to the market about what was likely to happen. So the market, I think, was overextended in terms of yields where they were. And then you got a sequence, a reversal of all this weak data. Now you got strong data at a time of bad market positioning. And then you throw in the election, the rise of Trump in the polls again, and the Trump trade, and those kind of things. Just in both, because we have term premium rising, taking out rate cuts, everything could go wrong for the bond market.
Quite a recipe. Can you break down the individual ingredients by measurement? How much of it is one versus the other? Do we know?
I think the first bit was just data. The recovery, like the 4%. 4%, I feel, has been a center of gravity for 10-year yields, all year long. We started the year at 390. 4 is not that much different at the beginning of the year, despite the roller coaster along the way. Rising since then, we got up to 430 on Monday. I think the last 10, 15, 20 basis points are around auction size deficits. And secondly, the potentiality that ex-President Trump may win again and implement bigger deficits and higher inflationary policies in general, raising term premiums. I think it was like half and half to some degree.
Do you think that it's gotten over its skis in terms of the election-related trade?
I think when you see a sell-off of 65 basis points in a matter of weeks when the Fed is cutting interest rates is extremely unusual. And this gets back to the interaction of fiscal and monetary policy since the pandemic. And one reason why we had this surge in inflation was super easy monetary policy and super easy fiscal policy. And since then, monetary policies had to work against still relatively easy fiscal policy. So it has a headwind to work with, which is one reason why higher rates have not caused as much economic weakness as anyone thought
I guess, how do you parse out whether this truly is the bond vigilantes coming back and raising concerns about the deficit
versus yet another overreaction that is an incredible buying opportunity?
We don't think it's an incredible buying opportunity, but it's getting back to reasonable levels. 450 on 10-year treasuries looks pretty good from a long-term perspective. Even if you think the long-term, neutral interest rate is 2%, throw in 2% inflation, a Fed funds of 4, 10-year at 4.5 looks reasonable.
Is this the ceiling if Trump wins and there's a sweep on Tuesday?
No, I think it's close to higher than that. At least the initial reaction.
How much higher?
Well, we peaked. We almost got to 5 back in 23, briefly, before we got weaker inflation data and everything kind of looked rosy again. I think 5 is the absolute worst it could be.
So if Harris wins, there's gridlock or sweep, how much do yields fall? Or they don't, because people are still pricing in fiscal stimulus regardless.
I think either party wins or takes control of things, you will get no deficit reduction going forward. Both parties have platforms to stimulate the economy, to help various components of the economy based upon their agendas, and that's probably not going away one way or the other. But I think the simulations I've seen, if you take the platforms and implement fully each platform, Trump policies are a little more inflationary, a little bit worse for the bond market, maybe up to 5%. Doesn't mean that the economy won't do okay, just the reaction of interest rates will be along those lines. And for Harris, a little bit less, but basically for most outcomes, interest rates a little bit higher. But also remember, term premium is really suppressed. Term premium bond yields went down a lot during the post-global financial crisis world with all the QE and everything. And now we're seeing a slowly rising term premium, which may not go away. So that's that upward pressure, which could come in fits and starts. It's not going to be uniform. Could be part of that process of normalizing things.
What gives you confidence that this time is different with respect to bond vigilantes coming back to a market that has faced off with a pretty big deficit for a long time in the U.S.?
I think it's because foreign investors, non-U.S. investors, and the Fed, the two combination, we're thinking about central banks, including the Fed, plus foreign investors, own most of U.S. Treasuries. The U.S. Treasuries are the global risk-free asset. It's the global store of wealth. We park billions of dollars. There's no alternative to that. So you could you could move shorter in the yield curve, do things like that, but I think there's no real alternative to Treasuries, and that will keep the yields could be gently rising, but won't disrupt the market.
Here's something you don't hear much on the campaign trail here in America. Over in the UK, Chancellor Reeves delivering the budget at the moment, saying this budget will raise UK taxes by 40 billion sterling. Gilt yields had been rising going into this budget. They're actually falling today by 7 basis points. The picture for the budget and fiscal prudence is very different over in Europe, isn't it? The approach is shifting big time.
It's extremely different. We know the UK has been very sensitive to ever since when Liz Truss was prime minister back in that September 22, I think it was, when chaos erupted in the gilt market in the UK on the back of potential fiscal irresponsibility. Other countries do pay attention to that, but I would say a country like Germany overpays attention to it. Yep. They do the opposite. They are too conservative.
A lost decade, I think, in Germany.
And
a lost decade of opportunities. Big time. Michael, thank you, sir. It's good to see you. Could talk about that a long time. Michael Kushma there of Morgan Stanley Investment Management. Let's give you an update on stories elsewhere with your Bloomberg Brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Alphabet shares jumping 6.7% pre-market. The Google parent company reported healthy gains in both revenue and profit. The company showed that its expensive foray into AI is starting to pay off, noting that a quarter of new code at Google is being written by AI. It delivered better than expected traction for its cloud computing business and drove more usage for its flagship search engine. Shares of Eli Lilly, on the other hand, tumbling this morning nearly 11% after lowering its full-year guidance. Sales of the blockbuster weight loss drug Zepbound and Mounjaro both coming in well short of forecasts. Lilly blamed inventory issues for the miss. Shares of rival Novo Nordisk also falling in sympathy with those shares this morning. Now, regardless of the outcome of the World Series, Fox and MLB are surely looking like the winners. Game 3 averaged 13.6 million viewers, beating Monday Night Football. It's the most watched World Series in years, averaging 14.4 million viewers a game, that according to Fox. Meanwhile, in Japan, the series is averaging almost 16 million viewers, even more than here in the U.S., equivalent to about 12% of the country's population. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead and look ahead to more big earnings after the close. We'll touch base with Bloomberg's Ed Ludlow in just a moment. The equity pop just fading a touch over the past few hours, slightly negative on the S&P 500 with the opening bell 36 minutes away. As we count you down to the opening bell, here's the trading diary through to next week. Meta and Microsoft reporting after the closing bell Thursday. More results from Apple, Amazon, Intel. We'll also get a BOJ rate decision plus another round of jobless claims and core PCE on Friday. The payrolls report on Tuesday, as you know, the US presidential election followed by a Fed rate decision just 2 days later. Investors in the meantime keeping an eye on big tech earnings after the closing bell. Ed Ludlow joins us now for more. Ed, before we look forward, let's look back just a touch.
Sure,
what are the nuggets, your big takeaways, the highlights from Alphabet?
Well, you'd be forgiven for having a sense of deja vu, right? Because the calculus is the same this quarter as it was when the last time the four of us spoke last quarter, which is here's all the money we're spending on AI in terms of CapEx. And fortunately for Google, this time around, they had something to show for it, right? $2 billion of operating income for the cloud unit, 35% top line growth for the cloud unit. I think what's so interesting about Google is like it's cultural, right? It's kind of ubiquitous, but we have a better sense of why they're doing well, which is that their strategy on cloud is to talk to startups run by people that used to work at Google. And there's evidence that our search or use of Google search is actually now adding higher value through the AI investment. So it was fascinating and they delivered.
Ed, did you see an election tailwind in there for ad spend?
Yeah. Yeah, and it's so important. They were explicit about it, right? Strength in the advertising sense on financial services and insurance industries, but the consumer's strong. The retail segment for Google was strong. And they said, yes, there is a tailwind from election season. They didn't quantify it, but like this is important stuff, right? Because we're less than a week out and people look for information. You'd think that Google would be the main beneficiary of that.
We'll see if this shows up in Meta a little bit later. Ed, appreciate your time, sir. Looking forward to the program, 11 a.m. Eastern Time, alongside Caroline Hyde, Bloomberg Technology, Microsoft, and Meta after the close.
Yeah, I think that's a fascinating point. How much do some of the social media sites get even more benefited by some of the ad spend than even traditional media?
For me, it's still 6 days to the U.S. presidential election. All I'm looking at is whether or not we're going to see more unforced errors on both sides of these campaigns.
A week of damage control so far. Up next on the program, Laurie Calvasina of RBC, Libby Cantrell of PIMCO, Pierre Ferragu of New Street, and Lindsay Rosner of Goldman Sachs joining us tomorrow morning. Looking forward to that from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.